I'm doing all these techie stuff. Let's see. All right, wonderful. So we are we are heading into the next segment. So right now we just went over asset protection and I showed you guys how to transfer your house, your car, and your businesses into the trust. So now we're making our we're pivoting into insurance and showing you guys how to build wealth with these types of policies. So I have the pleasure and honor of introducing our educator, the lovely Gerda Pierre. She is the founder of Solomon Financial Solutions. She has been in the insurance industry for over 14 years now, and she has a wealth of knowledge and information when it comes to these types of policies, right? So, index universal life insurance policies, whole life policies. So she knows them in and out. And what she's gonna do is she's gonna come on now and educate you guys and show you how to use these policies so that you guys can eliminate debt and how to use these policies so that you guys can start to build wealth with these policies and how you can connect it with your legacy, which is your trust. So this is the woman that I trust absolutely the most in order to educate you in this space when it comes to the life insurance policies, because once again, life insurance is supposed to be used when you are living, not when you are dead. Okay. So everyone here needs a policy, and our educator is here to teach us how and why. So thank you so much, Miss Gerda Pierre, for being here today and for agreeing to educate the community. We appreciate you so much.
Good afternoon, everyone. Some of you on here are already my clients, some I'm already meeting with, and I see a lot of new faces, so really excited to be here. So grateful for Christina. As you all know, or some of you may know, I am also part of the community, and so that's how I was able to become connected with Christina. Um, I have a trust that was created by an attorney. And I thought I was doing great things, but it wasn't until I met Christina at a conference and I started to have more in-depth conversation with her and understand the wealth of knowledge that she had that my attorney didn't have, that I realized that it doesn't matter if a person has a title, that doesn't constitute that they have the knowledge that you need. So my trust is my name because my attorney named my trust my name. And that voids the whole being anonymous, right? And when I asked him, hey, what do I do for the tax ID number? What do I do here? He said, oh, you could just use your social security number. So I always love to share that up front to let people know. Again, sometimes you may come on and say, well, is she an attorney or this or that? That means nothing in terms of the knowledge that she has. And she has a wealth of knowledge that I've seen be confirmed by the top estate attorneys before. So I'm just excited to be here, excited to be associated with Christina. Yeah, now just let me go ahead and get started. And I'm going to share my screen. And I have an extra year Christina took from me. So I've been in the insurance industry for over 15 years now. So yeah, I got to get my extra year. Okay. So
I knew it, but I've been saying 14
I
since last
know.
year. Yeah, because Gerda has been our educator for over a year now, our go-to educator when it comes to insurance. And so I've just been saying 14 years for over a year now. I had to keep a mental note every
Right.
year that goes by. And you know what? It's so good because it goes with the end. So we're in 2025. She's been there for 15 years. Next year is 2026. She's
That's
been there for
good.
16
16.
years.
Yes. So, I don't need to, I wanted to share this on the screen because it's just so much that I have done over my career in the insurance industry that I don't like to just blurt it all out. So I don't need to really go through in depth of what I've done or my experience or knowledge. So I do just want to share that the way that I like to equate myself is, many of you probably have heard this story, some of you have not. I like to think of it in terms of a restaurant. And what you'll come to learn from me by being in the community is I use a lot of analogies. And sometimes my analogies are crazy, but they make sense in the end. So I like to use it as a restaurant analogy. And what I mean by that is you all have gone to a restaurant. You have the waitresses, the hostess, the waiters, and the chefs in the back, right? So when you go to a restaurant, if you've ever been and you've sat down and you've asked the waiter or the waitress, hey, what comes on XYZ or what comes in XYZ entree, right? Sometimes you'll have certain waiters or waitresses that are able to tell you off the top of their head what comes on it, what doesn't come on it, and any alternatives, right? But then you'll have some that are not too sure and they have to kind of lean over your shoulder to look at the menu at the same time and just read off of the menu, right? And say, oh, it comes with this, it comes with that, right? And then you have those where they don't even know. And when you ask them, they have to say what? I'm not sure, but I'll ask the chef, right? So what I like to equate it as is think of me as being a chef in the back of the kitchen. I am not the one that created the menus, okay? I didn't create the menus or the entrees, but I know how to cook them, okay? So what's happening is been a lot of orders coming to the back of the house that have been incorrect. And because they're incorrect, we have to redo entrees or people are leaving, they're not happy, right? We have to refund. So what happened is you could think of me as being a chef in the back of the house. And I got kind of tired of seeing and different orders coming to the back of the house being incorrect. So I decided, let me take a step and go out to the front of the house and become a waiter or a waitress. Okay. And so the reason why I wanted to give you that analogy is because the majority of my career has been spent in P&C, which is property and casualty, which is your homeowners, your auto, that type of insurance, right? And I've held different leadership positions, senior manager, associate director. So the way you can kind of think of it is, if you've ever had a claim, whether it's an auto claim or homeowner's claim, and let's say your adjuster denied your claim, right? And you're like, no, my agent said I had that type of coverage on my policy. I have it. It should be there. And that person says, no, unfortunately, we have to deny your claim. And you're like, hey, I want to speak to a manager, right? Well, then you'll speak to the manager. And if the manager stands by what was said and you don't like it, then it's bubbled up to the next person, right? And so I have held positions in Fortune 100 insurance companies where I've been the one that it's been bubbled up to on the next set. So why did I want to kind of share all of that? Because with me being the chef in the back of the house and coming to the front, I have presented and educated agents prior to even leaving corporate America at summits, leadership summits, or agency summits to educate them on the importance of really understanding what it is that they're representing and that they are the liaison between you and the carriers. Okay. And so that has been my primary focus when I was in corporate. And so that's why I kind of stepped out because even though I was in those different positions, I myself, like many of you probably who have like a W-2, I was working and I had my insurance through my employer-sponsored insurance. And I thought I was doing great because I was like, let me give me 7 times my salary. And I thought that everything was perfect. But it wasn't until I started to hear more about the concept of becoming your own bank. And I didn't know anything about it. I'm working in insurance, in leadership positions in a Fortune 100 company that just so happens to be one of the top insurance companies. And I didn't know anything about what it meant to become your own bank, okay? Or infinite banking. The world has now made up these different names, right? Or like, what would the Rockefellers do, right? But the product has always been there, but no one has really educated anyone about it. And so when I realized, like, man, I'm here and I don't even have the knowledge or the education, and I had to go hear these little phrases here and there and go seek the knowledge on my own, that's when I realized that there was a gap. There was a big gap in what is available and what is in your hand or what you have access to, and something so powerful and the knowledge that people need, there's a gap there and people don't know. And there's a lot of people who don't have that knowledge. But what makes me different from other people or other agents, I should say, is that I have the skill set of policy interpretation and coverage analysis by being in my previous positions. So I just wanted to share all of that with you to let you know that I'm just not here as an agent. I know what the policy should say when it comes time for the claim, because you can get something today and think that, hey, I got it. It's great. And sometimes I'll meet people and say, "Oh no, I already got this type of policy," and I'm like, "Oh, okay, no problem." But it's not until we dive deeper that they realize that what they thought they had is not what they had, because every policy is not created the same. Okay. So just wanted to just share that. And some of this I do need to update in terms of kind of like what I shared with Christina when I was like, hey, it's been 15 now, over 15 now. This is kind of the same where I do need to update this presentation, like where it says over 9 million in transferable tax-free generational wealth. It's higher than that. So I do need to update different things here. In different endeavors. But that's just to kind of give you a quick outlook on the things that I've done, the things that I've accomplished. So, yeah, and this right here is my why. So I always like to share with people my why. And the reason why I do that is because all of you are here on this call for a reason. All of you are in the community for a reason. All of you have signed up and committed the time and effort it's going to take with these week-long workshops. And even after the workshop is done, the work doesn't stop. You have to keep going to finish everything for a reason. Everybody has a why. So when you get to the point and you're like, oh, this is so much. I got to go get this. I got to get tax ID. I got to find a grantor. I can't find them. I'm going to give up. Always go back to your why. So I want to just show you guys this so you know that I have a why, okay? And this is my why, but I have other whys as well. And my other whys are my family, my parents, my siblings. And the reason why they're also part of my why is because my parents, I'm Haitian. My parents are Haitian immigrants. They came to America on a boat. Okay. And why am I sharing this? Because all the accolades and other stuff you saw on the previous screen, don't think that, oh wow, she has all this knowledge. She's on a different level. She got that. No, I'm letting you know where I came from. My parents are Haitian immigrants. They came on a boat. Both of them. My father first came. It was about 12 of them on the boat. They only had one set of a paddle, I guess like the one pair of paddles, right? And the rest of them used their hands as they rowed their boat. And they left Haiti at night when the moon was up. And by them leaving Haiti at night when the moon was up, it allowed them to know that where they were headed, Haiti was behind them. So basically, they had no compass, no GPS, right? A lot of us, like myself, can't go anywhere without a GPS, but they used the moon to direct them. They did not sail during the day, they only sailed at night, okay? And then when they were about 2 miles off of Bahamas, the boat sank. Okay. Well, it started to sink. So they kind of had to flip it so it could stay afloat and swim to shore 2 miles off of the shore of Bahamas. When they got there safely with their little boat, they were homeless for 3 months. They did what they needed to do to repair the boat, and then they sailed to America. My mother then came shortly after him. I mean, after my father. She was pregnant with my oldest, well, with the third. It's 5 of us girls. I'm the last, but she was pregnant with my sister. And same thing, but her boat was filled with so many people that she remembers laying there and someone stepped on her stomach because they were trying to get to the other side of the boat because it was so packed. They had to drink salt water. Okay. The Coast Guard found them. When the Coast Guard found them and they were getting ready to take them in, my mother went into labor and they rushed her to the hospital in Miami, and my sister was born. So my sister was almost born on a boat. Okay. So I like to share that. And one of the things I shared with Christina that I recently found out, and I found out this whole story, y'all, when I took my parents on their first cruise, and I got them a balcony view. It was Royal Caribbean, and I paid everything, and I wanted them to just go and enjoy. And I remember my father sitting on the balcony, just sitting in silence. And he sat there with my daughter, and that's when he began to tell the story. I never knew that story until that moment. But I also shared with Christina that when they got here, they did things where they worked in orange fields and got 10 cents an orange. Okay. So I had my daughter do the math one day. I was like, if you wanted to make $200 a day, how many oranges would you have to pick? And she did the math, and I think it was 2,000 for $200 oranges just to make that. So I share all of that with you to let you know that that's also my why. Okay. I don't want their trip, I don't want their sacrifice to be in vain. So while I am here in this land, in this country, I'm living and breathing, I'm going to take advantage of all the knowledge that comes my way. I'm going to absorb it. I'm going to learn. I'm going to educate, and I'm going to pass it down so it is generational. And I share that with all of you because, again, you're here, you're getting your trusts, you're getting your policies, you're understanding, going to understand how to be the bank, right? But you need to understand that it means nothing if you're sitting in this room taking all these notes and you put everything in place, but you don't educate those after you. Because when you are gone, the knowledge will leave with you. So it's up to you, and you have a duty to share it with your wise as well. So a little bit about that. So I want to, now we're going to kind of get into, I'm going to shift from after this slide, I'm going to shift from here and go into my screen because I like to present more and, like I said, give more of analogies. But when we hear of infinite banking or like your family bank or my bank, whatever people like to call it these days, right? The reality is insurance, okay? Okay, insurance with a cash value component, okay? And so what people don't understand is that it is one of the most powerful things you can have in your arsenal. Is it the only thing you should have? No, right? But it's one of those things where you can't say that you have a powerful arsenal if you don't have them in your pocketbook or your belt. Okay. As you can see, I don't know nothing about no guns or no arsenal. Look, I said pocketbook and I don't know what it's called, the clip, who knows? But you can't say you have something powerful if you don't have this as part of your arsenal. And this is the difference of not only what allows you to create generational wealth while you're alive, but it also establishes your family when you're gone. Okay. So these are just a few people that I just wanted to just share with you that many people are not aware of that used the family bank concept to grow their empires, right? So one more thing I forgot to mention. So I'm very big on like participation, especially like, I don't really see faces, I don't hear any voices. So it just feels like I'm just talking to like a computer screen. So I'm very big on like drop it in the chat, put a one in the chat or put some fire in the chat or something. So please don't leave me out here by myself. So I am going to ask the question, has anyone, if you've been to Disney World or you desire to go to Disney World, drop, or you've heard of Disney, but you probably don't want to go, right? Drop a one in the chat for me. Okay, perfect. It was kind of delayed for me, so I was going to say Pretty and Denise been the only ones, but okay, good because everybody's been. Yeah, I'm also from Orlando, Florida, so I like to call it land of Disney World. So, and because I'm Haitian, I'm be honest, if you live in Orlando and you're Haitian, you know somebody or a whole bunch of people that work at Disney World. So since I grew up in Orlando, Florida, I've never had to pay for Disney World. Like I can go tomorrow and I won't have to pay for it. And it's like, that is crazy because you have family that has like, the comp tickets. I've never had to pay for it. So I don't even know how much it costs, but I heard it's expensive. Okay. So but what a lot of you don't know is if you've ever been to Disney, or even if you want to go or you've seen it, Disney World is massive, okay? They have Disneyland in California, I believe. I think they also have it in like Japan. They have them in different places. So many different places. They have different theme parks, okay? It's a huge conglomerate, right? But what people don't know is that Walt Disney was denied by 301 banks, okay? To get a loan to start Disney World. He was denied by 301 banks. Some of us probably been denied by one and was like, I gave up. Some of us have a dream or something that they wanted to work towards and they probably got denied a few times and then they gave up, right? He did a 301 times being denied. But guess what he was able to do? He was able to then turn around and get a loan from his policy to start Disney World. Okay. That is like what we see today, someone's dream that created this. I don't even know if it's billion or trillion, but I know Disney make a lot of money. And he was able to start that from an idea, from being able to go to his policy when others, such as the banks, said no. Okay. Then you have Doris Christopher, the pampered chef. Some of you might know about her, some of you might not. But she needed cash flow to do her dream, and she borrowed 3,000 from her family bank. And when I say family bank, I'm really just talking about that cash value component, right? And then you have J.C. Penney, which many of you know that or may not know, but you have like J.C. Penney and you had like your Sears, those department stores, which is like the Macy's, if you've never heard of J.C. Penney. But what people don't know is that during the Great Depression, he was at risk of everything being shut down, of losing his business because they didn't have enough money for operations to keep the operations going, right? And so he was able to utilize money from his family bank to keep the operations of his organization going and to keep his business going. Okay. You also have McDonald's. Okay. We don't even know that McDonald's, he took two loans from his family bank, okay, to continue to build more stores for McDonald's, okay? So I share all of this with you to say that this is not anything new, okay? It is nothing new. People have been doing it for generations. People have been doing it. And when I say generations, you might be like, Gerda, what you talking about? Insurance was started back in the 1700s, okay? People don't even know that. It's been around. It's been around for a long time. And many of the carriers that I'm appointed with, they've been around since the 1800s. Okay. So just let that sink in. So this is not a new concept, a new idea. Social media now makes it seem like it's all hot and do this and do that. But look at everyone you see on the screen. These are not 20 something year olds that went in their policies and got something. That means they were aware of something and they moved accordingly. Okay. So I'm going to stop sharing this screen for a moment. And then Gary, I see you already paid the hotel and theme park. You know what's odd though is even though I've never, and I'm pulling up my other screen, y'all, even though I've never had to pay for Disney World, I did share with my daughter. She's 17 now and she's going to college. So we're kind of like past that phase, but I told her we got to go do one more like hoorah, I guess, at Disney World before she goes to college. But I literally want to experience going somewhere and being a tourist. Like, I don't know what it is, but I want to go somewhere. I want to be a full tourist. I want to get the hotel. I want to wear the fanny pack. I want to, thank you so much, Portia. I want to go get the fanny pack. I want to do everything. But it's like I'm from Orlando, so but I'm gonna do it though. Can you all see my screen? If you can, just say yes or put a one, whatever the case may be. Okay, perfect. Okay, awesome. So thank you so much. So now when we talk about so the thing is everyone hears this phrase infinite banking, becoming your own bank and all of that, and they are just like fired up, right? The way people present it on social media, they make it seem like, yeah, you get this thing and it's going to start cooking and making money for you, right? But they make it seem like it's a microwave, right? But it's really a slow cooker. But even though it's a slow cooker, you still need to understand how it all moves and why it makes sense, right? Okay, because when you say become your own bank, keyword bank, infinite banking, keyword banking, bank, right? That means if you want to become your own bank or you want to now operate as infinite banking, what do you have to do? You now have to start thinking like the bank. Okay. So as I'm going through these different concepts, I like to always equate it to like a parachute. Okay. So think of it like a parachute. If you jump, knowledge is like a parachute. If you jump out of an airplane and you want to live, you got to do what? You got to open up that parachute. Okay. If you don't open up that parachute, then you're going to perish, right? Parachute, perish. But if you want to live, you have to open up the parachute. Same thing like your mind. You have to open it up to what you didn't know before because many of us don't know what we don't know. Okay. So when we look at this and we think to ourselves, okay, I'm pretty much just going to kind of explain to you just the basic fundamentals. I mean, I say basic, I'm not going to go into all these financial jargon, insurance jargon. This is just simple, basic ways of how our money overall should be flowing. Okay. So a lot of us are going to be making money. We make income. And the reason why this tank is so big, that lifetime capital potential, is because in our lifetime, we're going to make so much money in our lifetime. If you have ever said, I wish I was a millionaire, or if somebody gave me $1 million right now, I would do this, or I wish I was a millionaire. If you've ever said that, anything about being a millionaire or giving $1 million or anything like that, I want you to just drop some fire in the chat. I wanted to switch it up from a one, right? But drop something in the chat. Don't even have to be fire. Just drop something in the chat. Laura, boom. I like it. Explosive. Because I can't be the only one, even though you see me sitting here, I can't be the only one who has said that and said, "Oh, somebody gave me $1 million, or if only I had $1 million, this is what I would do." And it looked like it's only four of us, okay? Me, pretty, okay. We coming in, right? I can't be the only one. So we've said that, but what we don't realize is many of us have been millionaires time and time again. And many of us will be a millionaire by the time we're 65. Okay. But here's the thing, we're not going to see that money. Okay. Why? Because money is always moving. It comes in our hands, it goes out our hands. It comes in our hands, it goes out our hands. It comes in our hands, it goes out our hands. The average person will make $2 million by the time they're 65. Okay. But do you know how much the average person is going to have remaining in their hands by the time they're 65 and they retire? It ain't 2 million. Okay. It's 60,000. And that's including equity in someone's home. That's the average person at 65, which is why you see so many people going back to work. You go to Walmart and you see someone who's like your grandmother's age or even older than your grandmother at work. Okay. That's not the American dream. And so when you're making, you see this big old tank because you're like, I'm going to make all this money in my lifetime. I need somewhere to hold it. But the tank is not filled up. Okay. Because every dollar you make, okay, 70% goes to two people that are best friends, the government and the banks. Every dollar that you make, 70% goes to two other people who didn't wake up and go to work, who didn't clock in, who didn't do the work, who didn't push through days they were sick but had to go to work because why? Their why was counting on them. But they come to you and say, give me 70% of that. Okay. And what are those people left with? 30%. But then what do you have to do? You have to take care of yourself. You have to take care of your family. You got to eat. You got to dress yourself. You got to pay for shelter. So that's about what, 27% of your 30% that's left. And then many people are left with about 3% left for that savings piece, which is why when they're 65, that 60,000 I was telling you out of 2 million, that's that 3%. Okay. So we have the money, it comes in, you're making your income. And if you see the tank where it says inflow, the money goes through there. But guess what? It has to make a pit stop. And the pit stop is who? One of them was best friends. And who's the first one? The government. Okay. So they're going to take their portion. There's no, think of it like Monopoly. You can't pass unless, I think it's Monopoly. I ain't paying in a minute, but you can't pass unless you pay 200. That's what it is. Life is basically Monopoly. Okay. You have to pay your business partner, and it is your business partner no matter how you like to cut it. That is your business partner. The government is your partner. You pay them and they take their portion, whatever they see fit, and the remainder is left for you. Okay. And what's left for you, again, typically, what do? We pay our shelter, our rent, our mortgage, education for the kids, gas, our car notes, Netflix subscriptions, vacations, everything, right? So you have to do all of these different things that you have to make sure you take care of for your standard of living. But what a lot of us fail to do is we fail to forget about, oh, give me one second. My system is tripping. One moment. There we go. Okay. So what we should be having is we should be having money going in for our future selves. Okay. And we tend to forget about our future selves sometimes because again, like I told you, I just shared with you my background. I didn't come from financial education or anyone to teach me anything to the point when I was 16 and I started my job at Universal Studios in Orlando, up until about 2021. Well, really 20. I used to spend my money and just say, oh, I could just spend all my money because I'm going to get Social Security. That's literally where my mindset was as a 20-year-old. I'm going to get Social Security. That's a piggy bank that the government has made for me. I could spend all my money and I don't have to save anything. Now I look back and I regret it, right? But when you know better, you do better. And then you do better for the next generation and you share the knowledge. My daughter is now 17. She has her own policy. She understands she's just got a job, y'all, at Old Navy. Okay. I just let her to get a job, but she knows 70% of that paycheck is going into your policy. The other 30, you can do what you want, but 70, I'm taking it off the rip. Okay. So now I guess you could say I've become the government and the bank to her. So I'm taking 70% of her money, but I'm putting it away. Why? Because I'm doing for her what I didn't know when I started working. But typically our money should be going to our future self, and it should be going in these two tanks, which is our investment tanks, which I like to call the risk tank, or the savings tank, which is the safe tank. Okay. And then many of us who are still working W-2s, if you look at the top left, you see where it has that pipe that says qualified plan contributions. That's your 401k money that's going in. That's your SEP. That's your TSP contributions. When you get paid, you take that out first, you dumped it into the investments tank, and then the rest goes in that lifetime capital and it goes through. And then essentially, this is essentially what should be happening, right? What it should look like. So when you retire, we should be able to turn on those two distribution valves. And what is in those two tanks should now be taking care of our future selves, which at that time will be our current selves, either the same that is taking care of us today or better. Okay. So that's essentially how it should all be working. Okay. But is that how it all works? It's not. So you tend to sometimes have those who put the money in here, and and what I'll also tell you about myself as an agent is you have certain people that you come across, whether it's an agent or a financial advisor, whoever the case may be, whatever they represent, they are adamant to say, you put everything in here. This is what you need to do. You need to put all your money here. I am not that. I am very conservative. I am very old school in nature. Okay. And so for me, I like diversification, which is why I said you need to have this in your arsenal. I didn't say it needs to be the only thing in your arsenal. Okay. But when I like to talk about these other ones, I like to say, okay, well, when you have money go in these investment tanks, right? Your money is growing, your money is growing. Okay, it's growing, it's growing, it's growing. And you're probably thinking, yes, I got like 300,000 in my 401k now, and it's growing, and I'm gonna have so much money when I retire. But what you don't realize is that your business partner who is down here, they're also in here. Okay. So if taxes go down, they're gonna take less. If taxes go up, they're gonna take more, and there's nothing you can do about it. Nothing. And you might be saying, well, I have other investments, right? Which are still in this risk tank, which, like I said, I like to call the evaporation tank, and I'll tell you why. But I have other investments, let's say a Roth IRA, that I have funds in there. And when I take it out, it's going to be tax free. Well, of course, it's going to be tax free because guess what? Remember, your money came through the tax filter already. They already took their money. Okay. They took it before it was even dropped in the tank. So that's why it's going to be tax free. But the other thing is you have to wait. What if you're 40? You have to wait 19 and a half years to tap into that if you saw something that was an opportunity, like an investment or something. You have to wait 19 years before you touch it if you don't want to get hit with what? Penalties, right? And taxes. So those are things where you have to think of, but because they're all in the evaporation tank, which is why this does not have a lid, and this one does, because just like anything, like water, if you have water sitting in a cup and you leave it there too long, it's going to do what? It's going to evaporate. So the same thing with these tanks is you could have money sitting here and you wake up one morning and guess what? It's all gone. If you don't believe me, go back and to do your research and look back at history. The Great Depression, a lot of people lost almost everything, housing collapse. I'm just saying, this is not something that has never happened, okay? So that's one thing. But then you might be like, okay, well, I got majority of my money sitting here in a safe tank, right? Which is cool. But guess who's also in there? You start earning interest and getting gains and everything. What happens? Your bank sure enough sends you that 1099 at the end to find so you can report how much interest you earn, even if it's $1. Because how do I know? Because I've gotten one before and they wanted me to report my little $1.34. Okay. Okay. So that's the part where they're here. But you have other areas where you could put money in your safe tank, right? And when you put money in your safe tank, it's there, it's safe. Okay. However, one of the things I like to talk about, and this is kind of where I like to, let me go back. Let me see. It won't let me stop that. All right, perfect. This is where I like to just do a little bit of extra education. So with this particular tank, let's say someone's like, well, I have my money sitting in something that's safe and I don't have to worry about my business partner being in that cup. Okay. So now, even though you don't have to worry about your business partner being in that cup, let's say this cup has $100,000 in it. Okay. And if you've been here before, no, I have not gotten my stylist. Yes, I did check into it because I've been telling them I got pretty handwriting, everybody. If it's your first time here, I got beautiful handwriting, if I say so myself. I'm just using the mouse to write. And so it's going to be very scribble scrabble. I have looked into, I'm not tech savvy. They told me I got to get the iPad to hook up and set up and use this and use that. I haven't done that yet, okay? But I will get there. But I promise, even with the scribble scrabble, you'll follow me, you'll understand. So you have 100K, let's say, in this safe account, which is that savings account. And just because the tank is called a savings tank, it does not mean this is just it just represents savings accounts. Okay. It also represents like CDs, money markets, wherever you're thinking that I can put money to save, just so you guys know. Okay. But let's say you have 100K in a normal savings account that's in this tank here. Okay. And you decide you want to take out 30,000 to go do an investment. Okay. And why do I talk about investments? Because if we're talking about generational wealth, we got to make investments, right? So whether it's an investment in ourselves, okay, you're all here, you're investing in yourself. You made an investment in Wealthy Trustee and Seven Ways to Wealth into your family, your generation, right? You're making an investment of your time. Everything is an investment, right? So let's say you have 100K in the savings tank. You take out 30K because you saw a quadplex you want to buy for your family, for your legacy. And you only need to put down 30K. Well, when you take out that 30K, if you had 100K sitting in a savings account, you took out 30K, you're going to be left with 70K sitting in that account, okay? So what are you left with that's earning interest? 70K. But you forever gave up the opportunity to earn interest on this 30K. Okay. And someone might say, well, Gerda, I can put the money back like in a couple months. I could put the money back in 6 months. I'm going to work to put the money back. It doesn't matter. When you put that 30K back in 6 months, it's not the same 30K that left because each day that goes by, you've lost the opportunity to earn interest on that money had it been there. Okay. And so now you've forever given up the opportunity to earn that interest. However, when we start thinking like the bank and we start saying, okay, what are some other things that I could do that are available to me that if I'm thinking of this concept of becoming my own bank or infinite banking, where can I house my money that I know my money is going to be protected, that would allow me to be able to use the funds to be able to go do an investment that's going to allow me the opportunity to make more money on that investment while I still earn interest on my current dollars, okay? That would allow me to do that, plus other benefits that protects me and my family, okay? That's where we get to cash value insurance, okay? Which everyone likes to say, become your own bank, infinite banking. That's really what it is, okay? It is having a policy that has a cash value component in it. Now, historically, in our community, okay, we shy away from the word insurance, life insurance, because people equate it with death. People run and be like, I don't need it, right? But then God forbid when someone's gone, they trying to raise money, they trying to do all this different stuff to come together, but they were scared of it when they came because they feel like if they talk about it, that means you inviting death. No, it doesn't. That means you're being smart and protecting those you love, your why. But what people do is they have switched up the meaning and they made it more complicated than what it really is. It's called life insurance. It's not called death insurance. It's called life insurance, okay? Which means you're meant to use it during your what? Life. Remember them four people I just showed you? They used it during their life. But once they were gone, there was a what? A death benefit, okay? And the death benefit was to what? Their heirs. The life insurance is for you during your life, for you to use. Okay. And the death benefit is for your heirs when you're no longer here making those money moves, making those investments, spreading the knowledge down to the family and the generations. There has to be a benefit that helps the family make sure they don't start from what? Zero. Okay. That's why we have counterparts who are further along because their families didn't start from zero. That's how you can have a conversation with someone and say, my dad was a janitor. But how did you guys end up having this, that, and the other? Oh, he had insurance because he made sure his people, his kids, his heirs, his legacy didn't start from zero. So when you put your money into something like this, for instance, now we're talking about this in infinite banking, right? Now I want you to start opening up your mind and start thinking where the banks are and how they position themselves. Okay. So you start thinking like the bank, and you start understanding, if I put my money in something like this, and I'll explain why the death benefit is rising at the same time. Okay. But we're going to go back to that $100, 100,000 that I just used. And if you think, okay, if I put 100K in here and I saw a quadplex that I wanted to purchase for my legacy and put down 30,000 and I take out 30,000, okay? Why am I drawing this? Because I'm drawing this as a cup. Because a lot of people know that like I said, I use analogies and different phrases to make it more understandable and allows you to retain the information a little bit more, right? I'm not really with all the insurance jargon, financial jargon. But what you can think of this 100K as, think of this as your statement balance, okay? That's what the statement says, 100K, because that's what you got in there. You went and you took 30K out because you went about that quadplex, okay? I like to call this here your cup balance. Why do I call this your cup balance? Because after you took out the 30K, you technically only got 70K in your cup. Okay? That's what you have left in your cup. So let's just say you earn 5% interest. Okay. So next year, because you've earned 5% interest, your statement balance is now going to be what? Like, what's going to be your new balance? If you had 100K, and this is where I want you to drop some responses in the chat. It doesn't matter if you're wrong. It don't matter if you're right. It's the fact that you're trying to process what's going on to be able to understand. Now I'm thinking like the bank. You have 100K in your policy. You take out 30K to go do that investment. That leaves you with 70K in the cup. You earn 5% interest. So now this is where that compounding interest conversation is going to come in. You earn 5% interest. How much do you have? And I'll make it easier. What is your statement balance next year? Okay, let me find the chat. See if, okay, let's see. Oh, I think I'm going the wrong way. Okay, so your statement balance the next year, let's see, we have 105, we have 73,500, we have some good amounts. Okay, so I love the fact that even though, because I'll tell you which one is right, but I love the fact that you're dropping responses in there. Why? Because you're trying to process what the heck is going on here, and you're trying to think like the bank. You're going to have 105,000 on your statement balance next year. Why? Because remember, this is your statement balance. I'm going to call it SB. And then I'm going to call this one CB. Okay. Cup balance. Okay. Your statement balance, you had 100K in there. You took out 30K to go get the investment. It left 70K in your cup. But what are you earning interest on? You're earning interest on the statement balance. Okay. So next year, when you earned that 5%, that 5% was credited to your account, your statement balance is going to show $105,000. Okay. But guess what your cup now is? Because you just earned $5,000. So remember, your cup was 70 because we took out 30 to go do that investment. But now you just earned $5,000. So now your cup has what? $75,000 in it because you just earned $5,000. Okay. So that is what I like to explain to people to start thinking of what it means when you're like, okay, this is how it operates. Because a lot of people on social media are like, come your own bank, flip this money, put it in there. But no one's taking the time to explain to you. You are the people who have to go purchase it and get it, who desire it, because our counterparts don't have no issue. There's no there's no too much persuasion you got in because they know, right? And so it's like, why say, yeah, get this, get that, if I'm not going to educate you on why you need to know it? And why am I educating? Why am I big on education? Because, like I said, I may not be here tomorrow. If it's God's will, I am, right? But I need you to be able to take this education, this knowledge, and you're not going to know everything I know, but you're going to be able to take, like, okay, I know at least one or two things she said. It made sense to me. It clicked. So now she's not here no more. I can't even meet with her anymore. But now I got my grandkids, or I got my kids, or whatever the case may be, my family, my wife, my husband, whatever the case may be, that now I understand this basic fundamental that I caught. And I'm like, okay, we need to do something as a family. Or, you know what? I was planning on doing this investment. Now my wheels are spinning. I overeducate because I need you to, one, understand the basics, and I need your wheels to be spinning. Because you cannot say, I want to do infinite banking, I do it, and you're going off what social media is feeding you and pumping through you and making you think that you're going to have all this whatever, right? Which you are if you do it right, but you got to understand how to do it. Okay. So now next year, you're going to have 75K in your cup. But what I like to tell my clients is I like to tell them, always pay yourself back. Okay. Why do I say always pay yourself back? Because number one, if you are going to say, I want to have my family bank, I want to operate like the bank, I want infinite banking, whatever it is, the phrases are you're thinking of, you cannot tell me that you respect someone else's bank, an establishment, Bank of America, Navy Federal, whatever it is. You can't tell me you respect them more than you respect your family. What do I mean by that? If you went to Bank of America right now or Navy Federal and you got a $30,000 loan, and I came to you and I said, David, can I borrow $1,500? You're gonna be like, whoa, Gerda. I mean, I would if I could, but I got all these bills, and plus I got my loan that I got to pay for, and that payment is due, and it's 1,300. Why? Because you have made a commitment to pay who back? The bank back. Which is why you're like, nah, Gerda, nah, mm-mm. So when they're pushing like, yeah, you gotta pay it, you don't gotta pay it back, and they're gonna take from different, it's like, this is a truth, this is a fact. Okay. They will remove it from the death benefit, but why would you respect someone else's bank more than your family bank? Okay. But there's also nuances that go a little further into that I always tell people, if you're going to borrow from your family bank, your cash value, pay yourself back. But let's say you don't have a game plan to pay yourself back. Let's go back to this 30K. Let's say you took the 30K out and you're like, I took out the 30K because I saw this property and it was a deal and I had to take it. Okay. But let's say you're like, but I don't know when I'm gonna put the 30K back because I gotta renovate, I gotta put people in it, and then the kids are going to school. So I'm gonna sit down and think about when I'm gonna pay the 30 back. That's fine. But what I would say is make sure you pay that interest for that policy loan back before your policy anniversary date. They don't tell you that part when they all on the social media podcast and they're like, do this, do that. No, no, no. Pay the interest back. Why? Because now I'm going to go a little further. Okay. If it's okay with y'all, are y'all okay? Drop an okay. Or if you're following me, drop a one or a thumbs up. If you're like, Gerda, I'm getting it. If I'm like confusing you, say halt.
I was just about to ask about the interest.
Okay. Yep. I'm about to explain that to you now. Who was that? You sound familiar.
Nikki and G, Nikki.
Okay, I've never met. Hello, Nikenji. I've never met with you, but you sound like one of my clients. I was gonna say, hey, girl. So, okay, perfect. So I'm going to. Okay, good. People are understanding. Okay, so now, give me a second. I'm going to. Sometimes my system be disrespecting me when you got people watching you and then your stuff don't work the way it's supposed to work, and you're like, no, I know what I'm doing. Okay,
That's hilarious.
right.
It's
You be like,
disrespectful.
huh?
The system is disrespectful.
Oh, it's so disrespectful. I'm like, come on, what are you doing? You saw what it was doing to me earlier. So I'm going to put a little line right here. And I'm going to give you guys an example. Then I'm going to answer that question real quick about the interest. Why do I want to kind of go left a little bit and talk about the interest? Well, because even though you take that money out, why do I say pay your interest back? And first of all, a lot of the information and knowledge I share, I don't share something that I, Gerda, am not doing. Okay. So what would Gerda do is kind of like how I process. So when I speak to my clients and they're like, should I do this? I'm like, listen, I cannot direct you to do something, but if it was me, this is how I would be thinking and this is what I would do. So why do I say pay your interest back? Well, first of all, that's critical that you want to do that. You don't have to, but you need to and want to, okay? But I'm going to show you why you would need to and why you would want to need to, okay? If that makes sense. But again, in actuality, you don't have to, but I'll tell you what happens if you don't. So let's just say you have 10K, okay? Exactly. I don't know how to say the name, but I think it's Liddell Polk. But what happens is the interest is compounded too, because I'll explain that to all of you who may not know. So let's say you took out $10,000 loan, okay? And the policy loan interest rate is 5%. Okay. Just because you operate in like my family bank, your personal bank, all of that, you're still taking a loan out. So the difference is instead of Bank of America's title being up here, it's the insurance company's title up here. Okay. And why are you thinking, Gerda, why not my name? Because the insurance company is fronting you their money, so your money stays in the accounts to build money. What do I mean by that? That means like if Daniel had Daniel said, "Hey, Gerda, I got 100,000 in my piggy bank. Can you hold it for me?" And I say, "Okay, Daniel, I'm gonna put the 100,000 in my kitchen cabinet in my house." The only way Daniel could get to that money is if I let him in my house and get the money. So Daniel comes to me, he says, "I need to borrow 30,000 to go buy this quadplex that I saw to do this investment. I need my piggy bank so I can take money out of it." I'm gonna stop there and say, "Whoa, Daniel, you don't even need to touch your money. Leave your piggy bank in the cabinet. I'm gonna give you 30,000. I'm gonna give you 30,000 out of my money, okay? And I'm just gonna charge you 5% interest. And you could choose to pay me that 30,000 back, but if you choose not to pay it back, you could just pay me that 5% interest or whatever the interest rate is that each year, okay? But let's say Daniel's like, okay, he didn't get a chance to pay me back. So God forbid something would happen. We're not even gonna use Daniel no more because I don't like using people. Let's say Bob. Something happens to Bob. Bob family comes and says, "Hey, Bob had told us he had his piggy bank at your house in your kitchen cabinet. We came to collect it. He said it was 100K in there." Okay. Well, Bob's family, he does have it in my kitchen cabinet, but I gave Bob 30,000 to go do some investment deals, and Bob ain't never paid me back. So I'm gonna give you this 70K back because I'm gonna keep 30 for myself because Bob owed me 30. So that's kind of the concept of why you don't have to pay back. But let's say Bob never paid the interest along the way. I'm going to take out the 30K plus whatever interest that accrued that Bob didn't pay back. Okay. Everybody follow me so far? Now, the great thing about the policy loans is that it's simple interest. Okay. And I love simple interest, which means we're going back to our example. You have the 10,000 you took out, 5% interest. That means you're going to have what? $500. And I could be wrong. Let me make sure, y'all, because I didn't eat today. So it's been a long morning. And I don't even want to say I didn't eat today. It's like I didn't eat yet. So Bob has, yep, okay. I knew my math, but I don't know why when I wrote it. Maybe because it's ugly how I wrote it. It just didn't look right to me. But you took out 10,000. It's a 5% interest rate. Now you have $500 in interest. Okay. Let's say today, June 6th, is when your policy started. Okay. And your policy anniversary date is going to be when? June 6, 2026. So everybody got that? So just to put it on the screen somewhere, I'll put it at the bottom so we can follow. So your anniversary date is June 6, 2026, okay? Because it's a rolling 12 months. It's not annual. Everybody good so far? Okay. So now you took out the 10K. You went to go do what you needed to do. If you're like me, my daughter just graduated, right? And so I took out 10K. And this is true, what I'm telling you. Like I took out 10K because I needed to do some stuff for school. So, and my interest rate is about 5%. So let's just say my interest is about 5.2 or something like that. But we're going to use 5% to make it easy. So that's 500 of interest. But let's say I got my policy today. It started today and I took the money out. Okay. Well, that means that on the 6th of each year of June is my policy anniversary date. Okay. So what that means is I have until basically I got 12 months or less than that. So my policy anniversary date is in November. I have 4 policies total, but the one I took it out of, the policy anniversary date is in November. Okay. So that means if I took it out in May, I have, what is that? November's 11, May's, I have what, 6 months to pay back the $500 of interest if I choose not to pay back the 10K. Which means when I pay this $500 back before November, which is now I'm talking about me, Gerda, okay? When I pay this $500 back before November, my anniversary date, what is going to be my loan balance? It's still going to be 10,000. So what happens is the interest rate is a variable interest rate. It's a participating variable interest rate. Why do I have that one? Because that's the one that allows my money to keep gaining interest as if I never touched it. Okay. So now I pay my $500 back before my anniversary date. My policy loan is still 10,000. Well, let's say that now when my policy period has started over, so from November 2025 to November 2026, the interest rate is now 4.5%. Because why? Because it's variable, right? So now that means until my next policy period anniversary date, right? I have to pay $450 back before November of next year. Everybody following me so far? Okay. So why do I want to show that? Because every policy period, and policy period just means when your policy renews, right? The policy, and this depends on what type of loan you take out of your policy. Why am I explaining all this deep, in-depth stuff? Because again, if you're thinking like the bank, you need to think like the bank. Don't just think, oh, I'm gonna get this policy, I'm gonna drop this money and I'm gonna go pull this money out. Well, you probably got a standard loan, and that goes a little deeper into what types of loans different carriers offer, right? So now it's like, okay, I took out 10,000. I'm going to pay the 500. I'm gonna tell you right now. When am I gonna pay back that 10K? I don't know. I'm gonna be very honest with you. I don't know. I have 4 policies. I have a whole life, a term, and 2 IULs. The IUL that I took this out of is like, oh, okay, well, if I'm gone tomorrow, they just gonna take 10,000 out, not 10,500. Okay. And next year, when my policy renews in November and the 10,000 is still outstanding, which it is gonna still be outstanding, to be very honest with you. Whatever interest rate they charge me, if it's 4.5, well, then I got 12 months to pay back $450. Understand what I'm saying? Okay. Now let's just say you're like, well, Gerda, what if you don't pay it back? Well, if I don't pay it back and we go back, let me take some of this out. If I don't pay it back and we go back to the normal 5%, well, when my policy anniversary happens, now my balance, because remember, if I don't pay my interest back, my policy anniversary comes. Now my loan balance is, my principal amount is 10,500. And then let's just say now the interest rate is 4.5% because it's a variable. So now my interest is going to be, I'm going to be charged 4.5% on 10,500. So this is where the compounding comes in. Okay. And then just to make the math, just to make it easy. Well, no, I don't want to guess. So I'm going to do 4.5% times 10,500. That's $472.50. Okay. And you might be like, oh, that's less than this 500. Well, that's only because the interest rate is different. What if the interest rate stayed at 5%? Okay, then I'd be paying 5% on that. But then let's just say I don't pay this 472.50 back by the time what? My policy anniversary date hits. If I don't pay that 472 back, guess what my principal, well, you know what? I'm gonna wait. I want y'all to drop in the chat. What would be my loan balance now, my principal balance? If I don't pay this 472.50 back, which is just the interest. Exactly. $10,972. And don't forget the cents. Because people get a little iffy with their cents. So $10,972.50. So that is how the interest becomes compounding. Guess what? Now you have 10,000. Now you have $10,972. Oh, Lord. And 50 cents. And then let's say the interest rate now is 5.4% that year. Now you're going to pay 5.4% on whatever this is. And if you don't pay it back, it's just, so you see how the compounding interest? So if people are not educated to understand, everybody's so focused on this side of the spectrum, that compounding interest of what you're earning inside of the policy, which is amazing. And which is why I call it a slow cooker and not a microwave. Because when you start off, like anything, it starts off slow. But once it starts building up and it starts cooking, it starts cooking. Okay. But you have to understand on the other side, if you're now like, I need to take money out to go do an investment, you need to understand why it's so important to always remember to pay the interest at least. Because what's going to happen if I pay my interest at least each year, my principal is just always going to be 10,000. I'll put the 10,000 and I want to put the 10,000 back, right? Because it'll make my cup go up, but my cup is high enough that it's like, I'll put, and I didn't take that big of amount out, but if I got a larger amount, like 30 out, well, I'm gonna put the money back in the cup. Everybody following me so far? And I'll kind of explain to you why I use like the 100. So I use the 10K because why? Because I, Gerda, took out a 10K loan, right? My interest is like 5%. I did it for my daughter's stuff. Okay. And you want to always take funds out when it's a major capital purchase. And what's a major capital purchase? It's when you can't pay for it with your normal income. Okay. And you want to do it when you're also going to do investments. What do I mean by that? So you might hear people say, so remember how I said it, I'm not saying don't put your money in other things or anything like that. It's just saying if Amazon did something with their stocks or Tesla, whatever, and you're like, oh snap, I can go get a lot, right? Or you're like, I'm gonna go get Bitcoin, or I'm gonna go get XRP, whatever it is, right? I got 50K in the bank, I'm gonna go take out 20 and go put it in an investment. It's like, why would you go take why would you go take 20 out your bank account when you got enough in your policy to go take 20 out to go do the investment? Because why? You're going to still be earning interest on the what? Y'all remember the statement balance? Because if you take it out your bank, now you done dropped your balance to 30. And now you know what I mean? So, but if you take it out here, you're earning interest off the statement amount. You took the 20 out when to go get the stock or whatever it may be, crypto, whatever. And you never gave up the opportunity to earn interest over here. Now you're earning money off the same dollar. Why? Because you're still earning compounding interest over here. You went and got the investment, and let's say the money is doubling, is tripling, is doing what it's doing. Now you done earn money at the same time, twice off the same dollar. But let's use the other side of the coin. Let's say that investment tanks. And you're like, oh Lord, they told me to get Dogecoin or whatever it is, right? When everybody went and got it and it tanked. But at least, even though that 20K is gone, you're like, oh my gosh, at least that's not 20K that's gone from your savings account that you're like, I got to now work each day to get back up to that 20. And every day that went by, I lost the opportunity to earn it. Over here, you took it out. You're still earning the interest off that 50K as if you never touched it while you're paying your what? What do you want to always pay when you take a policy loan out? Drop it in the chat, unmute, whatever you want to do.
Interest,
Interest. Before what?
the years out.
Nope, not the year, almost. But I get
Your
what you're saying. But what is it?
your anniversary year.
Your anniversary year. Your anniversary date, actually, because your date, if you got it today, you got to June 6th, you want to pay that before so it doesn't compound. But now you done lost all that money in the investment, right? But guess what? You're like, ooh, Lord, they took that money out of the investment, but you know what? I know I got $1,000 of interest out, but I got 12 months to pay that, and I'll figure out over time how to put my 20 back in there to fill my cup back up, right? Because if you don't fill your cup up, you got to wait for the annual drip of the interest you're earning to go in the cup. You see what I'm saying? So that's why you always want to pay yourself back. And what I mean by that, because I'm a visual person, so that's why it's like they be visual. So remember, if you had 70K in your cup, and you earned that 5%, remember that 5K that you earned that following year because of that 5%? And then let's say the very next year you earned 10K or whatever the case may be. Do you see how each year you're waiting for the drip? But what if you paid you got your 5K, but then that next year you got a bonus that you wasn't expecting? Or you won the lottery, who knows, right? And you say, you know, I'm gonna dump my 30K back in that I took out. Now you dumped your 30K back in. Now what happens? You have access to your full 105K that's in your cup. Does it make sense? Instead of waiting annually to get the drip, because if you got the 75 the following year, you had the 70, then you got the 5K that was dumped in. Let's say you see a whole apartment complex. The person's retiring and they don't have no family. They just want to sell it and for a steal. And they say you just got to put 100,000 down. When you ain't got enough in your cup. Your statement says 105. That's what you're earning interest off of, but your cup only has 75. Do Do you see what I'm saying? Why it's important to have a plan? And what's happening is that when you have that, and how am I doing on time, Christina? Yep, I only have about 14 more minutes. What is that? 14. Am I right? About 13 more minutes, I would say. So, or 17, 18 minutes, y'all. My math ain't mathing because I did not eat today. Okay. But about 18 more minutes, I want to kind of quickly go through. But when you have that, the reason why you want to make sure that you're paying that back is because, real quick, just to go over it with you. So, the way insurance works is that, and when we're talking about infinite banking, is there's a minimum and there's a maximum. Okay. So the minimum is determined by the insurance companies. The maximum is determined by the government. Okay. Even though the government ain't in your business, they kind of in your business, but kind of standing outside the door. Think of it like they're looking through your window. You got that nosy neighbor. They wish they could come inside the party and come into the house, but they looking in the neighbor and looking in your window to make sure that if you did something that the HOA say you couldn't do, for example, now they're going to go snitch and tell, and now it's like, now you owe us, right? It's kind of like a tripwire. But when people aren't educated, some people can trip over the wire. And then that's where you hear these things about, oh, IUL don't work, or this or that don't work. It's like, because no one educated you about the tripwire, and now you done tripped. And now, you see what I'm saying? So the government determines the maximum, the insurance company determines the minimum. And there's so many different ways, okay, that you can have your maximum and minimum set up. What do I mean by that? So for example, Christina is I'm just throwing her age out there. I don't know her age. I'm just throwing a random age out there. But Christina is a 34-year-old woman who wants to do $500 a month. Her goal is cash accumulation. Why? Because she wants to use this like that infinite banking, become your own bank concept, right? Or she just wants to really grow a lot of cash in it and she doesn't want majority of her money going to pay for the death benefit. So her goal is cash accumulation, minimum death benefit, okay? That means that what Christina's makeup is going to be different from Gerda, okay? I might be a 37-year-old woman and I want to do 500 also, just like Christina. But now my makeup, my maximum, my minimum is different. We have the same goals, but it's different. Same thing, different from Daniel. He might be a 35-year-old male who wants to do 500 also, but because he's a male, his makeup is different. You understand what I'm saying? So it's so many different ways that you can build the designs, okay? So I quickly, what people don't know is that in the 1980s, okay, that's when qualified plans were introduced. So all of us, we have come to, it's kind of like where you get a job, you need to get a 401k, you need to get a SEP, you need to get a TSP, you need to get all these things, right? 403b, all of this. Because it's been ingrained in us because of why? Because those 1980s is when it was introduced. Your employers get an incentive when we all sign up for these 401ks, okay? Remember, the government is hiding at the bottom of your 401k well. They're at the bottom, which means when you're throwing all that money down the well and you thinking nobody can get to it except you, when it's time for you to go collect what's at the bottom of the well and you turn on the light at the bottom of the well, you see somebody sitting right there with their hands crossed, suited up. They done organized all your ones, all your fives, all your tens. You got the crisp bills. They bounded. Everything looks good. But then they say, this half is mine. That half is yours. Okay. And why did they do that? They did that because they wanted to steer people from these type of different avenues of where to store their money. Okay. And so remember, think of it like they're looking through the window. They've been trying to get into it. And remember, how long has insurance been around? Insurance has been around since 1700s. This is nothing new. It's nothing new. And I think that's what the biggest piece I try to press towards people and press upon people is it's nothing new. And if you knew the different things that the government, different mandates or different things they've tried to pass over the centuries to try to, over the years even, to try to get a hand in it, you'd be like, wow, this must be something serious. Think about it like this. If everybody's after one person, that person got to be very powerful or got to have something that everybody just don't want that person to get where they need to get. Okay. So, but then again, the government, they got hands all in it too. One of the biggest owners of life insurance is banks and the governments and other countries. Okay. Saudi Arabia has a lot of policies. China, bank-owned life insurance called BOLI. All right. FDIC, that money that you have in that savings account when they said they're going to insure it up to a certain amount. FDIC, insurance. Okay. Insurance companies have insurance. Insurance has more money than the government, believe it or not, because insurance companies have insurance. And even those insurance companies have insurance. Oh, the rabbit hole goes deep. But when you just kind of see some of these different things here, the different things that you have to deal with these qualified plans, even when I even briefly mentioned the Roth IRAs, for example, well, you have a 10% penalty if you take money out before 59 and a half. You see a deal today, you got to wait 19 years, but I need it today. Okay. So policies with premiums above, and this is something I'll go, I'm working with Christina to probably do like a master class in the coming weeks to be able to have an opportunity to go deeper into other different concepts, right? But there's something called the MEC, which is basically how I gave that example about Christina, Daniel, and myself, all three of us wanting to get a policy, put a certain amount in, but our maximum and our minimums are different because of our amounts, our ages, our gender, right? And what happens is our maximums are different, but that maximum is set by who? The government, and that's called the modified endowment contract. Okay. And so the government put that in place because that's the tripwire I was saying. They looking through and they hoping that you just don't know and you go over and you trip over that. But what I like to reassure people is the companies that I work with, we have measures in place to prevent you from getting tripped over. Okay. Because if you ever tried to purposely trip yourself over, they're not going to accept your deposit and they're going to reach out to you, have you sign an affidavit and acknowledge you understand what's about to happen. And they're going to reach out to me to make sure I reach back out to you to make sure you know what's about to happen. And then if you say, yes, Gerda, take this money, I know it's going to be a MEC, which is a modified endowment contract, that's when the insurance company takes it. And again, that's not for every insurance company. I'm just only speaking from perspective of the ones I work with. Okay. And just because we're pressed on time, I'm going to kind of go through a little bit through, but same thing with like the qualified plans. Remember how I talked about the government sitting at the bottom of the well? Not only do they, people say defer, but it's really postpone. They postpone the tax and the tax calculation, meaning they're going to take your tax from you. They're going to take the tax, but they're going to postpone that tax calculation too. And there's nothing that you can do. People don't even know the taxes have been as high as 95% before. And income tax, for those of you who don't know, was introduced in 1913. And it was introduced to be a temporary thing to help the economy get back on track after the Civil War. But guess what? They realized they was making money and they kept it. And there was a point in time, I'll get the exact year, it's like 1930 something, where one year, if you made over 5 million, the taxes was 80%. The very next year, anyone who made over 200,000, you went from 5 million to being taxed at 80% to 200,000 to being taxed at 88%. So if you think that taxes is high now, oh, you ain't seen nothing yet. Okay. So I always like to just let people know it's a tax calculation. You also want to know what tax bracket you're going to be at the time of your retirement. Exactly. Yes, Laura. Exactly. And what deductions you're going to have when you take the money. So that's what people don't even realize too. Yes, the government's going to take their taxes when it comes time for you to get all that money out of 401k. What tax bracket are you going to be at? What's the tax calculation? What are going to be your deductions at the time? So I'm just going to kind of go through this because this is kind of what I explained when I was just talking about the maximum and the minimum. So if we kind of use that example, they would say, okay, the minimum you could throw in there is 500. The maximum would be 10,000. This line at the top is like that MEC limit. If I go over that limit, right? And this 500,000 just represents what's that death benefit they would give me based on me being a woman, 38, wanting to do $500 a month, but my maximum would be up to 10,000, right? And I can get this amount of coverage. This is kind of what this whole diagram just displays, okay? And I'm going to kind of go through and then like even that was just kind of talking about term, which we know term actually only pays out 3% of the time. And term is actually the cash cow of the insurance industry, to be honest, because why? It expires. It expires. That's why they only pay out about 3% of the time for term. I have a term, just like I mentioned to all of you, but I have a term because of what? I have a term because my term keeps up with my insurance. I mean, not my insurance, my term keeps up with my mortgage. What do I mean by that? Meaning, in my mind, the minute I got a term, my house was paid off. What do I mean by that? Because when I got that term and it was a 30-year term, I had a 30-year mortgage. If I pass away today, my house is paid off. My daughter don't have to worry about using any money from any of the other policies to pay off this house. The house is paid off. If I don't pass away in the next whatever 20 something years that's left on my term, my house should be paid off. Why? Because I had a 30-year mortgage. 30-year term is keeping up with it. Okay. And that's why I don't pay my mortgage company extra money like I used to. When I tell you, I told you about thinking, I'm going to retire and have Social Security. One of the other things I used to do is pay biweekly so I can get the extra or make an extra mortgage payment so I can get the extra, get more interest taken off. But then when I realized, like, hold up, it's all about cash flow. Hold on. It's about interest earned and not interest paid. I decided, no, I'm not giving them no extra money because I have that policy, that term, keeping up with it. If I'm gone, house paid off. If I'm not gone, house gonna be paid off in 30 years. It don't even matter. But the extra money I would have been giving to them, I could put it over here. And what would that look like in 30 years for me? That extra money I was giving them. And that's a whole different thing that I'm probably going to do a master class on that to show you how would you like to pay for it is what I'm gonna call it. And that's going to break it down on what that means. So let's see. I'm just going to kind of just put all these up here and then I'll stop here so we can kind of go through any questions. But these are just like the different benefits that when you are thinking of a vehicle of where you want to put safe money. Why do I call it safe money? Again, like I said, I'm the type that says you don't have to put all your eggs in one basket, but you have to have different baskets because if this one is gone, you got something over here where you don't have to start from zero. Okay. Do I have stocks? Yeah. Do I have crypto? Absolutely. XRP. Okay. I got it when it was 19 cents. So if you're just not getting into it, I got it when it was 19 because I listened. So I have different things in different places, right? But here's the thing. God forbid, if I lost all of that in all the other areas, it doesn't matter because majority of my money is in my policies. If you come to me with a play and I need to pull money out, where am I going to go? To my policy to pull it out. If the play didn't work, it just didn't work. But I still did not give up the opportunity to earn my interest. But when you're thinking of like a vehicle of where you want your money to be safe, these are all the characteristics you want it to have. Okay. And what I can tell you is that when you start opening up your mind of becoming your own banking, what does that mean and what vehicle would help me become my own bank? Okay. I can tell you right now, cash value life insurance policies, keyword cash value life insurance policies have 11 out of the 12. The only one it doesn't have is the last one, which is the deductible contributions. Why? Because you're purchasing your policy, you're paying your premium with after-tax dollars. So that's it. I'm gonna stop right here and then give enough time for questions. Definitely went over my time, but like I said, it always happens. I always go over my time a little bit, but I always like to be able to use that opportunity to really educate everyone. So I hope you all enjoyed it. I will turn it over to Christina or maybe do I just go and ask the questions, Christina, or go to like the questions or?
Thank you so much, Gerda. We really, really, really appreciate you so much for coming on and just educating us on these powerful policies. So, yeah, we're gonna go ahead and open up the floor for Q&A. So you can dive right in. I see the first hand I see is TY.
Ty?
Hello, hello, how are you?
Hello, I'm good, and you?
I'm great. Thank you for all the information. This is awesome. Thank you, Christina, for facilitating everything and the information you provided as well. Um, I wanted to ask about the borrowing from I have two questions. The first question is like everything that I've seen about infinite banking, as I've been looking into it for a while, it seems like there's large payments that you got to make. Not probably not have to, but it's something like that, where it's like a decent amount of money a month you have to put down on it. Is that what you've been seeing, or like what's a general? I know it's hard to answer that question, but like what's like a general monthly thing that you would have to pay? And the
Yep.
second question, I'm sorry, I'm gonna just throw the
No,
second
no, you're
question
fine.
out to be done. And the second question is when you take a loan from the policy, which you're getting the loan from the insurance company, the interest rate that getting from having the money sitting in there, is that interest higher than the amount of interest you have to pay back to the loan?
Okay, very good questions, both of them. So first, I'm going to answer your first question about the general amount. So no, there's no specific amount you have to put in. So kind of going back to what we had with where I gave like the example with like Christina is given a certain amount. She might say her budget is 500. Because I like to talk to people and I make you do a financial questionnaire so I can understand your financial landscape. Because Christina might say, Gerda, I got 500 a month of disposable income that I just want to tuck away in a policy, right? And you might then say, yeah, my budget, I only got like 200 or I got like 150 I could put into a policy a month. That then is going to determine your amount, your age, and your gender is going to determine what that amount is. What do I mean by that? So can you guys still see my screen? Can you guys still see it?
Yes.
Yes.
And
Yes.
I'm just trying to figure out where I can have like blank screen real quick. So what do I mean by that? So let's just say Ty is I'm just going to throw an age out there for you, Ty. Ty is a 30-year-old male who wants to do $150 a month because that's what his budget calls for, right? His goal is cash accumulation and minimum death benefit. So I go to the insurance company and I'm like, hey, he's 30-year-old male, wants to do 150, wants cash accumulation, minimum death benefit. The insurance company, I'm just throwing a number out there. Let's just say the insurance company is like, okay, we'll give him the minimum death benefit we can give him that can allow this 30-year-old male to put 150 in with minimum death benefit would be 100K, for example. Okay, I wouldn't know, Ty, until I actually put your actual numbers in. But let's just say, for the example purposes, it's this. So what that means is this 100K, anytime you pay your 150 that you came to me and said, Gerda, this is my budget. And then when I look at your financial questionnaire to see if there's any other areas where you might be throwing away money unknowingly and unnecessarily that you didn't know about, right? I may look and say, okay, Ty, well, this is the 150 that you want to do. It's the minimum death benefit is going to be 100K. Every time you pay your 150, for example, let's say $30 is going to come out to pay for this death benefit. Okay. The remaining $120 is going to go into your cash value. Okay. So that's why it's not a specific number where you're like, hey, Gerda, how much should I put in? It's like, well, how much do you want to? What is sustainable? Because again, this is well, the other thing too, these type of policies, because they're so powerful, they're not available to everybody. What do I mean by that? You have to qualify for it. I like to say your health is your credit. Okay. But also they like to see, do you have income? Okay. Because I've had some people come to me before and they don't have income, but they want to try to get a policy like this. It's a risk for the insurance company. It's a risk for myself. It's not something that they would take on. You have to have some form of income. And no, there's no income minimum you have to have. You just got to have some kind of income because the income is going to determine how much insurance you can get, how much you can afford, and it has to make sense. So if someone came to me and said, I make this much amount and these are my expenses, but I want to do 500 a month. And I'm like, no, 500 ain't going to work for you. We need to probably budget 150 because we need to make sure what you're paying your premium every month because this is not a bill, everybody. This is your legacy. Because if you treat it like a bill, what's going to happen when other stuff come up? You're not going to pay it. It's not a bill. This is an asset. So much so that when you go purchase a home, there's a section for you to put cash value. Oh, I don't think people even know that. There's a section there that even in home ownership, that the banks and the homeowner mortgage companies want to know how much you got in cash value because they consider it an asset because it is an asset. So that is determined. You give me your number, Ty, and then I determine with the insurance company, well, not me, but the insurance company then determines how much insurance this can afford. And that's how I'm able to tell you the breakdown. Okay. Then we have, so there's no general amount to pay. You come to me, we talk, we look at your stuff, and we come to a number that's comfortable. Let's say you're like, Gerda, my average is between 150 to 200, for example, right? Well, we got to find out what's more comfortable, 150, 175, 200. What works for Ty? because it needs to work for Ty so Ty can remain consistent. And my premiums, y'all, is like set it and forget it. If you ask me when my premium is pulled every month for my policies, I don't know. I don't know because I make sure that money is there and I make sure it's like clockwork. Take your money. If anything, that money don't exist to me. So we would just have to talk to determine what that is for you. And then just real quick to get your other question, when you said when you take like a loan, like what is the I wrote it down, try to remember, but I wrote loan from loan. I don't know why I wrote that.
Sorry, I'll tell you again, is that the interest that you pay more or less than the interest that is being added to the account?
Okay, now the one thing I want to just do real quick, and this may limit how much time I have for other questions, but I'm gonna take a few more, but I want to try to see if I can get through this real quick. So I always like to tell people it's not about, and I'm gonna go back to that question you have, but I need to explain this first. Everyone always is so focused on like the interest rate, right? But people need to understand it's not just about the interest rate, more so about something else. So I'll give you an example. So let's say this one has 10%. This one has 6%. Oh, Lord. And this one has 4%. Okay. Oh, that do not look like a 4, y'all. Do it? No, it don't. All right, there we go. And this one has 4%. Okay. And I want everybody to just drop in the chat real quick. Which bucket would you pick? All I'm saying to you, the only information I'm giving you is pick a bucket, and the bucket you pick is the interest I'm gonna pay you. Everybody got it? Okay. Yeah, everybody going with the, oh, Denise said give me 6. Okay, Denise. Because I know me, Laura said 4. And let's see. Okay, so real quick, if I could just have Laura come off of mute and just tell me why did you say 4?
I said 4 because I figured if it's the interest that you're going to give me, then it's also the interest I'm going to have to pay you.
Okay. Very good. Very good thought process. So just for time's sake, I was gonna ask somebody else to also give me their reason, but for time's sake, I'll just move on, right? Well, no, this is just exactly that. So kind of what we talked about. Remember how I said life insurance, it's for your life, but we equate it like it's death insurance, right? We need to go with what it is. So just like I said, pick one because this is the interest I'm gonna pay you. It's not interest you're gonna pay me. So this was what I would be giving you, right? But I now say, okay, majority of people pick 10%, right? Laura picked 4%, so I'm gonna give Laura her 4%. And I think someone else has said 6%, Denise. So I'm gonna give Laura and Denise they 6% and they 4%. Okay, I'm gonna put D here for Denise and L here for Laura. So, but majority of y'all said 10%. Okay. And so now what happens is I'm gonna reveal what each bucket has. So I say, okay, well, this bucket right here, this had $1,000 in it. So everybody who picked this bucket, great. You made $100 in interest. Awesome. Then I come here and I say this one had 100K in it. Everybody who picked this bucket, you just made 6K of interest. Love it. But then I come here and say everybody who said 4%, this one had 500K and you just made 20,000 of interest. Okay. So why did I want to show this? Because Ty's question was, are you paying more interest than what you're earning? It's about how much you're funding more so than it is about the interest rate. Yes, they tie together because you might be like, well, Gerda, what if I put my 500K in this 10% bucket? Well, then you're going to earn 10% off 500K. But if you were thinking of husband and wife, and come for me if you want to, but this is just how I was raised. Husband is the head of household, okay? So if you're thinking of it like that, there it is. You got to have how much you're funding, because if I was funding only 1,000 and I only got 100 of interest, but I got 10%, mind you, okay? I got 10%. I've only put 1,000 in there, but then I took out a loan that was probably at 5%, right? That means my balance may not be as high if I'm taking out a loan, right? And I only put in 1,000. But what's happening is the goal is to where it's like a wash. Well, what you're putting in is not, the 5% can't really keep up with the growth, because that's why, unless, let me back up, because it is variable interest on the policy loan. Remember, with these IULs, we cannot guarantee you an interest price. I mean, an interest rate. Okay. We're not in the market, we're just following it. And what that means is up to the cap, let's say the cap is 10.5%. And let's say the strategy that you choose is S&P 500. Okay. Now, let's say S&P 500, based on that strategy, it earned 15%. Well, what are you going to get? You're going to get the cap, 10.5% for that year, right? That's credited. Okay. But then let's say you took a loan out next year and your loan was at 5% interest rate, but then the strategy S&P 500 did 2%. But now you earned 2% interest, right? But you have a 5% loan out. However, even if you earn 2% interest, remember how you earn 4% interest right here? Even if you earn 2% interest, the goal is you want to fund as much as you can and have the ability, financial ability, capacity to do into your policy up to what it can consume, absorb. Remember that MEC limit? You're going to have a limit. And if you have, I'm going to give you an example. If you have $500 in your pocket, no, I'm going to take it back. If you got $10,000 in your pocket, your MEC limit is 10,000. Let's say it's 10,500. You got 10,000 in your pocket, but you can put up to 10,000 if you want, but you only got to pay 500 minimum each month. Which one you going to do? You going to just put the 500 because yeah, that's all that I got to put in my policy, or you going to dump in the 10,000? Because you got it in your pocket. It's not doing nothing. It's not earning interest. It's not making you money. It's not doing anything but sitting in your pocket. And you could put up to that much in your policy. Now you have that much in your policy. Now when you need to take it out, even if it's a 5% interest, 4% interest, whatever, and even if S&P 500 earned 2% this year or whatever the case may be, or you had 0%, because if it tanks and S&P 500 goes negative, you don't lose your money. You just didn't make any. That's why we say zero is your hero. Okay? So it all just, that's why you want to keep up with why I said, this is not a bill for me. This is my asset. When I get extra money, I'm dumping it into my policy. So to keep up with that, you don't want to be taking out excessive loans, right? And you're not even putting as much into the policy. Because now that's where it talks about education and why you need to understand the workings of it. The interest doesn't really matter. It's more about how much you're funding it. And I go back to answer your question, it's no limit. So don't feel like, man, I only got $150 a month I could put in, or $250 or whatever. Remember, it's not the whole 200 or the whole 250 that's paying for the insurance. Majority of that is going into your cash value component. Okay? Nothing is too small. It all just depends on you and what's your ultimate goal and what you want to accomplish. I hope that answered it for you, Ty. I went the long route and did it, but I hope me giving y'all a little bit of extra something made sense as to if you can dump in more money into these policies and you have the capacity and you're still in your working years, you better dump in more money, because that future self, you might be thinking, oh, $100 extra a month is not going to make no difference. I've seen people's cash value projection triple just by adding an extra 100, just by adding an extra 25, 50. You think it ain't no difference? It's a difference. So nothing is too small. So I hope that answered it. Sorry about I took the long route. Christina, you let me know how much more questions I can answer, because I want to be respectful of your time. Okay, well, I don't know. Well, let me skip the line then. Let me go ahead and find. I see, I'm just gonna go in order. I have here Nikki's hand up.
Hi,
Hello, Nikki.
and thank you. When you are paying back, say you got a loan, or what loan, when you're paying back, how do you determine that? How does the insurance company know what you're paying? How do they know if you're paying interest versus the principal versus your regular payment,
Mhm.
or the cash value portion of it, or the death benefit portion of it?
Yep. So when you pay your monthly premium, that automatically, that segmentation is already done for you. Meaning if your monthly premium was $200 a month, Nikki, and $30 was coming out to pay for your death benefit and 170 was going to cash value, you're paying 200 a month. You're not doing 170 and 30. You're not doing it. Your premium is 200. They're doing the segmentation of 30 is going to be paying for that death benefit, 170 is getting dumped in your cash value. So that you don't have to worry about. When it comes time to repay your loans and principal and all of that, every time you pay your 200 a month, that's already allocated. That's like your auto pay because it's on set up on auto pay, right? That's automatically for your premium. 30 pay for death benefit, 170 go cash value. When it comes to your loan, you then go in to your portal or you call the insurance and you're like, hey, I want to pay my 500 for my interest that is showing I have interest on this loan I took out. I want to just pay that. Or, hey, I want to go ahead and pay the full principal and the interest. Or, hey, I just want to pay some of the principal, right? It's really up to you. So let's just say back to that example, the 10,000 with the 5% interest rate, policy loan interest rate, which is 500 in interest, right? Simple interest. Let's just say you got a bonus from work and it was $6,000. And you're like, oh, I mean, it hasn't accumulated all the way up to the 500 yet. Okay. And you're like, I got the 6,000. I just want to dump it in and just pay back 6,000 of my 10K loan. Let's say you pay back 6,000 of that 10K loan. Now you have 4,000 left as the principal. And let's just say you forgot about going back to pay your interest before your anniversary date. Well, when the policy renews, it's going to, the policy loan now is 4% at whatever interest rate. But whenever you're making your payments, you tell them, I want it towards principal, I want it towards interest.
Okay. And the MEC limit, that's a annual limit that you have to abide by. Is that right?
The MEC limit is up to the first 7 years. So the MEC limit, just to kind of give you guys some insight, is basically saying, let's say your MEC limit is 10,000. We like to call it a 7-year pay test, which means you cannot exceed that limit within 7 years or you will make your policy a MEC. Meaning, if you have $10,000 a year is your MEC limit, 10 times 7 is 70,000, right? So that means in 7 years, the most you could have dumped into this policy would be $70,000. Okay. And what that means is if you exceed the MEC limit, it becomes a taxable vehicle like a 401k or anything like that. But when we get into all of those, that's on the game. However, let's say that first 7 years, this is 70,000, right? That's the MEC limit. Let's say in year 1, you dumped in 13,000, for example. Remember, your 7 years, the overall is going to be 70,000. Year 1, you dumped in 13 because you just got a bonus. You're like, look, I'm giving y'all 13. Well, next year you did your 10, you did your 10, and you did your 10 as normal. But then when it comes to year 7, they say, well, you're only allowed to put in 7,000. And you're like, what? Why? Because you dumped in 13 in year 1. And the 7 years to keep it from being a MEC, we can only accept this 7,000 to prevent you from going over the MEC limit. After that 7-year period, now I like to call it wiggle room. That's why I like to build policies with some wiggle room. So now if you know that you want to start dumping in extra money along the way, you still have a little bit of wiggle room. You don't have to have wiggle room, but if you have a little bit of wiggle room, you can dump in a little extra each year up to that amount, which is called the guideline. You can dump in up to whatever that guideline is after the 7-year period, which is going to be that wiggle room. Does that make sense so far? A lot of it makes sense when I look at like a person's individual illustration and I'm explaining the what we're looking at on the screen, your illustration. That's when all of it makes sense. But I hope I was able to answer it.
Okay, it's a little bit better with that now. And my last thing is, okay, I know this, like the $200, that's monthly. Can you go ahead and pay it up for a year so you don't have to just remember to do monthly payments?
Absolutely. Yep. I just, so the way you have 4 payment options, you can do annual, you can do semi-annual, which is just twice a year. You can do quarterly or you can do monthly. I just always like to just use monthly because it's just a little easier for people to break it down. Yep.
I think I'm good now. Thank you.
You're welcome. And then I'm gonna say, can a globe video Lidell poke?
Hey, how you doing?
I'm doing good, and you?
Getting through it. Thanks for asking. I'd like to say thank the both of you and Ms. Yvette for the collaboration. And my question, well, I would like for you to touch on the correlation of the premium and the age benefit for the life in the lock. What do you call it?
The MEC.
No, locked into your premium, the benefit of getting it at an early age and not waiting too long.
Oh yeah, the earlier you get a pot, like you're talking about the earlier you get insurance, the benefit.
Right.
Oh yeah, the cheaper. The earlier you get it, the cheaper, which is why I love talking to families. Like I said, my daughter has an IUL and she just started her job. So, and I fund that IUL, right? And she's 17, but she got it before she was 17. Now that she has a job, she's going to be funding the policy with her own money. And then when she becomes a doctor, she'll get another policy because her income has increased and these other two policies can't fit that much money into it. So she'll get another one. But the younger you are, the younger you get it, the cheaper it is. In addition, insurance historically tends to be cheaper for women than it is for men just because of the mortality rates. Look, don't come for me. The actuaries is just, when they do the mortality rates and the actuaries, it just shows that women tend to live longer than men. So that is one of the reasons why when you look at the mortality tables and all of that, that you can see that. That's why it tends to be cheaper, which means a 35-year-old woman may pay less, well, will most likely pay less, not all the time, but most of the time, pay less than a 35-year-old male. And what we mean by less, we don't mean like she paying $300, $400, $500 less, or no. It just means it is going to be, even if it's $5 less, the fact is it's less. So the younger you are, the better. For example, my sister, and actually, no, let me use a client. So I have a client, she's doing she has 3 kids. One of them, she is doing like $100 a month for that child. And with that particular child, she's the youngest. She's the 6-year-old. And she also has an 18-year-old and she has a 12-year-old, I believe, or 14-year-old, an 18-year-old, and a 6-year-old. Well, the 6-year-old, by the time she is, I believe, 65 or so, if the mom takes advantage of dumping in extra money each year, and by extra, I mean like an extra $200-$300 a year, okay? If the daughter will have like, she'll have over $1 million, and this is her at 65. And remember, even when the mom is paying $100 a month, the whole 100 is not paying for the death benefit. But the daughter will have over $1 million, whereas in her sibling, where the mom is also paying 100 for that sibling, by the time she's 65, her projection, 65, her projection was about, I want to say it was like 600 something thousand. So the younger you start, the better, because it just makes a big difference in cost. And it gives remember how I said these policies are slow cookers? It just means your stuff starts cooking and it starts cooking faster. So I hope that answered it for you. I don't know what happened to the screen.
Doesn't that lock you in where you don't have to look for the increase in your premium also?
So what happens is if you increase your death benefit over the time, and real quick, just because it just popped in my head, if you increase your death benefit, you will have to go back through underwriting. Yes, it will change your premium payment, but it does allow you to lock that in where you have the cost of insurance that it's costing you that minimum premium. That's what that minimum premium will be. Okay. So for example, if it's the $30 a month that's coming out every time you make your payment, $30 a month is going to come out of that 100, 70 is going to go in your cash value. It is going to lock it in. Let's say you had wiggle room and your wiggle room was you could pay up to $200 a month, for example. When you pay that $200 a month, 30 is going to come out, go pay for the death benefit. 170 now is going to go into your cash value. So the earlier you get it, the better, because the cost of insurance is less. The older you are, even if it locks it in, the older you are, the cost of insurance is more. I hope that made sense.
It does. Thank you.
You're welcome. All right. And then I think I'll leave. Christine, are you there? I don't know if you wanted me to take another question or I want to be respectful of your time because I went way over.
Oh yeah, go for it.
So let me see. I think Laura is next.
All right. So my question is, so I have a life insurance policy. It's seems like it's more for death, because it's literally about the funeral expenses and stuff like that. So I just got something small that could cover a funeral, like 25,000.
Okay.
However, is it possible from what I'm hearing, is it correct that if I wanted to, that it's better to get like whatever death benefit you want to get it the highest amount you can up front, because if you go years down the road and want to increase it, it's basically like you started over as far as getting the underwriting process and having to be charged at that amount?
Well, so let me back up. So if you wanted to increase what I like to call the base amount. So again, everybody is different. So when you're talking about like insurance, you have different types of accumulation that you can select. Okay. And your insurance will, let me go back to what I had over here. Hold on. Your insurance will increase over time. Give me 1 second. Okay. So remember how, can you see my screen still?
Yes.
Okay, so you're putting your cash, the green is your cash value that's growing, and the blue is the death benefit. Well, the death benefit is increasing because the cash value is growing, okay? The cash value cannot exceed the death benefit, because if it does, it turns it into a MEC. So what the insurance companies do to prevent that is they raise your death benefit to keep up with the growth of the cash value. So your death benefit is going to go up. And what I mean by that is, let's just say, is this Laura I'm talking to? I
Yeah.
think. Okay. Let's just say Laura is a 30-year-old woman. She said, I want to do $200 a month. The minimum death benefit they said they would give Laura is, let's just say 200,000, for example. Out of that 200,000, when she pays her, let's just say 250. So Laura pays 250 a month. Out of that 250, let's just say 40 is paying for death benefit, and 210 is paying for cash value. Okay. So, but Laura's base is 200. Okay. Let's say 30 years from now, Laura's cash value amount in her policy, your cash value, let's just say, I'm just going to say, let's say it's 500. Okay. For example, 500,000 is what your cash value, what you have in your cash value, which is this green. Okay. But your death benefit now, it grew from 200K to now 700K. But if you were to come to me, but where every time you pay your premium, you still paying your premium of the 250 a month, right? Every time you pay your premium of 250, 40 is coming out to pay for the death benefit, which the base is technically 200K, and the rest is going in cash value. So when you have a 700,000 death benefit, it's called increasing, meaning your family, your heirs are going to take this 200K base, and they're going to take the 500,000 of cash value. Why do you want minimum death benefit max cash accumulation? Because like you say, if the higher the death benefit, the more it's going to cost, which means if I did this for you and you were like, Gerda, I get that they want to do 200K for me, but I need at least 250 because of my assets. Whenever someone comes to me, if they say, Gerda, I want 500,000 of death benefit, I ask them, well, do you have 500,000 of assets that you're trying to protect? No. Well, why are you looking to pay for 500,000 worth of death benefit? Because it's going to cost you to pay that. So let's say you're like, Gerda, I know the insurance company said they're going to give me 200K as the minimum death benefit because I want to pay 250 a month, but I need at least 250K. Well, let me put this down. I need at least 250K of death benefit so I can cover my assets, but my budget is still 250 a month. I can't go more than 250 a month. Okay. Well, I'm going to tell you, well, Laura, I know you want 250. Instead of $40 coming out every time you pay your 250 a month, they're going to take out 50 for the death benefit, because 250 costs $50, for example, and only 200 is going to go in your cash value. Okay. And you might look at this and say, oh, Gerda, I like this because I got the coverage I want. The difference of me paying for the death benefit is only $10, and I'm okay with that. And that may work for you, and that's okay. But if you were to come to me and say you want to get 700,000 worth of death benefit, it's like, well, Laura, it's going to grow to that at some point. Why do you want to pay for that today when you're going to continue to just pay for the lower one? Does that make sense? So it's like, why are you trying to get 700,000 when it's in 30 years, your family's going to get a check for 700 if you're not here, because they're going to get what? The base, which is what? The 200 or the 250K. They're going to get the base plus your cash value, which is also why you want to pay yourself back. Because let's say you had 500K in your cash value and your base is 200 right here, but then you decided, YOLO, I worked hard. I'm gonna take out 300,000 for myself and go live it up. That's your money. Do what you want, right? Well, now that 300,000 is gonna be taken out of the 700K, so your heirs are gonna get a check for 400K. They're gonna get the 200K base plus the 200K that's remaining in your cash value because you took out 300K and went YOLO. Does that make sense?
Yeah. Yeah. And so would you be able to take, like, say, cash value out from one policy to start a new policy?
Can you do that? You can, because nobody can stop you from doing that, right? Because once you take the money out and you have money sitting in your policy, like let's say your bank account, and you're like, Gerda, I want to dump this into a new policy. I don't know where that 10K came from, right? So theoretically, you actually can. But is it a good idea to do it? It really just depends on you understanding. That's why I need you guys to understand the nuances so you can take a look at your policy to say, okay, I took out 10K out of this policy. It's at 5% interest. I got, the 12 months for my policy period before my anniversary date. I want to get this new policy. I'm going to dump it in here. You can. One of the questions on the application that the insurance companies do ask sometimes, though, is the person going to fund this policy with basically is your premium going to be financed? Because they need to make sure, do you even have the money? You're trying to dump this in, and you're trying to do this, but do you actually have the money to do it? Because again, it's a risk. It's like they're using borrowed money to put money here, but what happened if they can't get the borrowed money anymore to put here? So they do ask that question as well. So, like I said, theoretically you can. So if you came to me and said, Gerda, I got 10,000, I want to dump it to this policy, but you, Laura, know that you went to your policy last week, your other one, took out $10,000 loan and, was deposited into your account, and you come to me and say, I want to start a policy, I got 10,000, I want to dump in. I'm not going to know unless you tell me, right? So it's just, you're just gonna have to know, like, what's Laura's game plan. If Laura did that and Laura's like, oh, I'm gonna dump the 10,000 back into my old policy once I get my bonus in March, but I wanted to get my once I get my bonus in like October, but I wanted to get my policy today, but Laura, have a game plan to put that money back, then yeah. So I just
That
always,
makes
you're gonna take it, have a play to put it back.
that makes sense.
Yeah.
Yeah, because the woman I got my policy from, she was like, you can't even touch your money until at least a year.
That is correct. If you have an IUL, if you have a whole
Yeah.
life policy, you can't tap into the cash value till 30 days later. If you have an IUL, and the I know that's enticing when people hear that, but I always tell people that only really makes sense if you're like an investor and you're dumping in a large amount and you need to take some out. Let's say you're about to go buy a $30,000 property and you got 60K sitting there. You're like, I want to dump it in, start a policy and take it out and go whatever. Well, you're going to need that before a year. Okay, your whole life is better. But IUL, you cannot take funds out. When you start a policy, you cannot take funds out until month 13, which is a year later, because we have to establish that statement balance. So we have to get to that point where you have that statement balance. After that, that statement balance is there and it's established. That's when you can start borrowing. That's the reason why.
Awesome. Thank you so much.
Thank you. Awesome. Okay. D'Angelo. It looks like we have two more because I think I answered Ty's and I answered Nikki's. So it looks like D'Angelo, and then we have Will 2K.
All right. Hi, Gerda. How you doing today?
Hello, good, and you?
Doing all right. I have two questions. I'm gonna try to make it brief for time's sake. So going to your example earlier about the modified endowment contract, you have 7 years of the annual premium to not reach the MEC. So let's say, for example, using your numbers, if you're doing 1,000 a year and let's say 2 years in, you come into a windfall of money, can you contribute that money to the policy, or do you have to like create a whole nother policy in order to avoid the MEC?
If it's within your limits. So I'm just, and I tend to repeat myself so I can make sure I understand. So not because you didn't say it right. So let's just say a person is doing $1,000 a month, and or even if they were doing $100 a month, which is $1,200 for the year, or $1,000 a month for $12,000 for the year. Okay. And that is what the person has selected. So is this D'Angelo?
Yes.
Okay, so D'Angelo, for example, I just tend to use like 10,000, 1,000, 100 because they're easier for me. So let's just say you said, okay, Gerda, I want to do 1,000 a month, and you do 1,000 a month, and that's 12,000 annually. The 1,000 that you told me is, I like to just give it a nickname of selected premium. That's what D'Angelo selected. He wanted 1,000 a month, but D'Angelo's MEC is, let's say, 18,000 for the year. Okay. So D'Angelo came to me, everybody. He said he wanted to do 1,000 a month. That's 12,000 for the year. D'Angelo's MEC limit for the year is 18,000. Okay. D'Angelo comes across some money and he gets a bonus from work. Let's say he got a bonus from work for $10,000. So now D'Angelo has paid his 1,000, paid his 1,000, paid his 1,000, but he got this bonus and he like, I want to dump this in my policy. Well, D'Angelo would only be able to dump in, it's two scenarios. The first scenario is D'Angelo possibly may be able to dump in that full 10,000. Okay. But depending on where we're at, remember I told you the 7-year pay test. So 12 times, let's see, 12 times 7 is 84,000. So within the first 7 years of this policy of D'Angelo doing 1,000 a month and him doing 12,000 annually, that's 84,000. Okay.
Got it.
However, D'Angelo's MEC is 18,000. Okay. So now I'm gonna do, just so you know what I'm doing 18 times 7. That's 126,000. Okay. D'Angelo gets a bonus in year 1 for 10,000. He paid his normal 12,000. He gets a bonus for 10,000. Now he dumped in what? $22,000. Okay. Next year he does his, let me see. He does 22,000 in year 1. Next year you do your normal 12,000. The following year, year 3, you do your normal 12,000. Year 4, you do your normal 12,000. Year 5, year 6, okay? You did your normal. You ain't dumping nothing extra, okay? Well, that's 82,000. So you technically can do up to what? 126 because your MEC was 18,000. Okay.
Got you.
So technically you can dump in whatever that difference would be. You're in year 6 or year 7. It's 82. You can dump in to get to that MEC limit. However, on the other side, and this all just depends because that's why every different variables make different illustrations, right? Because I've had clients who we've did their illustration and based on their demographics or their age or how much they were putting, it didn't allow them to go all the way up to the MEC. It allowed only their guideline, right? So different variables. But the other scenario on that is you could probably say, hey, I got this. I do 1,000 a month. That's 12,000 a year. I got this $10,000 bonus I want to dump in. They may turn around and say, D'Angelo, because of your earnings that you had through the market or whatever that we've credited and all of that, the most we can accept is up to the MEC limit, which would be 6,000 out of your 10 because you had already 12. Now 6 makes it up to the MEC limit of 18. Now that other 14, that's where that other 4,000 we have to determine, okay, do we just wait till next year to dump that in? But let's just say you came into some big money, you won the lottery. You cannot dump that in all into your policy. You can dump it up to that limit, but then that's where we turn around and say why you need another policy. So with my daughter, she's a teen, she has a policy, but when she becomes a doctor, that little money that I'm putting in this policy can't fit doctor income into that. So now she has to get another policy.
Right.
That's why I have 2 IULs because I got to one where it was like, okay, well, I can't put no more in that. So let me get a second one. And now I'm stuffing them both, if that makes sense.
Yeah, that does make sense. And you definitely answered my question. And the second one, briefly, Earlier, you spoke about the variable insurance, how like the rate goes up as you age. Would this strategy work if you do like a level insurance policy to where the insurance doesn't increase?
Oh, when you say variable, were you talking about like the
Or I'm
policy loan?
increasing. I'm sorry, increasing. That's what you said.
Okay, yep. So if you're doing level is just that. So what D'Angelo is talking about, everyone, is let's just say you said, hey, I want to do 250 a month. And I typically don't use level unless typically I use that for like my older clients, but I always
Mhm.
start off with increasing. And then if it doesn't work, because it doesn't always work for my older clients. Sometimes, most of the time it does, but if it doesn't, I have to use level. What does level mean, y'all? It just means that if this person said, I want to do $250 a month, I want cash accumulation, da 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 da, all that, right? Level just says instead of, it gives them a set of insurance and it's level. So let's just say it gave them 200,000 worth of death benefit. That's 200,000 is their death benefit. It's level. It just stays 200,000. However, when we go back to what we have here, even though it stays 200,000, well, let me take this away. Okay, even though it stays 200,000, right? What happens is when the cash value starts to catch up to the death benefit, that
It'll
person's
mech.
200 is going to start going up.
It'll mech. Yeah, I
No,
get it.
it won't mech. It's going to start increasing. They're going to start making, so let's say the person had 200,000 and let's say in 30 years their death benefit is now 170. You're going to notice that that person's death benefit is no longer 200,000, it's now 210. Why? Because now they have 170 they're earning interest on. And by next year, let's say, for example, they earned 20,000 of interest. Now they're at 190. In order to prevent it from being a mech, the insurance has to keep bumping the death benefit
Got you. Okay.
because the cash value is at the rate the cash value is growing, they have to keep bumping it. But then at some point, depending on how much that person has been paying for insurance, right, is going to get to a point where the cash value is going to equal the death benefit. Okay. But that essentially is you basically just walking away with free money if you're still here. Let's say you live till 120, 121, and people gonna give you your money and say, go about your business. Okay. But let's just say, right, it gets there, it's going to get to a point where it's going to equal the cash value and the death benefit are going to equal, right? Because there's only so much insurance that you've paid for, and the amount of growth that you've experienced, the amount of death benefit that it's risen. Now, if you're younger, kind of going back to like Dell's question, when like the younger you get it, I've seen where the younger they are, they get it, that cash value just keeps growing and the death benefit, the cash value doesn't catch up as often. I've seen where it has done it, but it doesn't catch up as often to the death benefit. But that's kind of if it's running to like age 120 or 121.
So you recommend the increasing over the level?
Um, I wouldn't say I recommend it. I would say that as me as Gerda, I always just start with increasing, only because it's going to always start you off at a lower death benefit and couple it with your cash value. Now, the reason why I say I don't necessarily recommend one over the other, because it depends on you, the client, and what your ultimate goal is. Okay. Because if you are like, hey, I want the cash value component and cash accumulation, but I also want, God forbid, if something were to happen to me, my family be okay with a larger amount of death benefit, then we could start with like the level. But increasing, you're going to start at a lower death benefit, which is why not that much is being taken out of your premium to pay for the death benefit, and majority is going to cash value. So it really just depends because, well, like I said, I could run an illustration and you could be a 35-year-old male and think that, oh, it's going to work. And then we look and say, oh, no, this don't work. And I'll show you why it doesn't work. So it really just depends. It's not one over the other that I prefer, but I do typically only use level if it doesn't work for a person. And typically if it doesn't work, I've seen it where increasing doesn't work, and I've seen it where it happens with my older clients.
Got you.
And by older, I mean like 65 plus. And that also depends on how much they're funding it. So it's all about like making sure. That's why structure is so important, because it's not a cookie cutter way. It's very important when it comes to structure and how you're structuring it, and knowing what the client's ultimate goals are to ensure that you're structuring it the way that would help support their goals. So.
Well, thank you, Gerda. I appreciate you.
Thank you. I appreciate you. Thank you so much. And I think the last question is, will 2K
Yes, thank you. Thank you for taking the time. You've been very, very informative. My
Thank you.
question to you, my question to you is on the MEP situation, wouldn't it be feasible just to have multiple policies? Continue to just add policies?
Um, no, not necessarily, because if you're going to have multiple policies, then you might as well just increase your premium for the policy that you currently have to increase your MEC limit. What I mean by that is, let's just say someone said, I want to do $200 a month, and that's 200 times 12 months is 2,400 for the year. Let's say their MEC limit is 5,000, right? But then that person says, but I want to get a second policy and I want to do $300 a month, which is 3,600 for the year, 300 times the 12 months, 3,600 for the year. And that person's MEC limit is on that policy is, let's say, 6,000, right? Well, in that instance, it's like, well, why do you have two policies when you could just, the 200 you're trying to pay for this one and the 300 you're trying to pay for that one, just be a $500 premium. 500 times the 12 months is what, 6,000 annually?
60,000.
Yeah, 6,000. And then your MEC possibly on that, depending on like your age, how much you're putting in, right? Your MEC possibly on that may be what does that say? Your MEC probably on that may be 11,000, for example. And again, these are numbers I'm just randomly throwing out, not numbers set in stone. But your MEC on that may be let's say 12,000, for example. So that's an extra $6,000. Whereas in the first one, when you were given 200 a month times 12 months, which is 2,400, let's say the MEC on that was 5,000, which is really just a difference of $2,600. And then the one where you were doing $300 a month times 12 months, which is 3,600 for the year, but you had a MEC limit of 6,000, that's just a difference of what? 2,400. So the 2,400 plus 2,600 is $5,000 total overall that you could dump in, when you could have easily just got one policy, pay $500 a month, and have a MEC limit of 12, which gives you room of 6,000, a whole extra 1,000 that you could dump in. You see what I'm saying? So
I understand.
yep, I only talk about like multiple policies when someone gets to a point where they can no longer, like, it is beyond the wiggle room that they've built in, and they got massive money that they want to say. And by massive, it just means if you said I want to do 300 a month, 300 times 12 is 3,600. Your MEC gives you is 6,000, which is what is that? 2,400, right? Gap.
Yes.
And let's say you're past that 24, that you're past the 7 years. So now you can't put the 6,000 anymore, but your wiggle room is now, let's say 5,000, which means you have wiggle room of 1,400 every year to put in. But now you got this promotion and you get a $10,000, $15,000 bonus every quarter. You know what I'm supposed to do with this? Now it's like, okay, we need to talk, because you can't put, you capped each year.
Okay. Last question.
Uh-huh.
Question. Have you heard of the term premium finance?
Oh yeah, premium finance. Yeah, premium finance is
Okay,
typically. Oh, go ahead.
No, please expound, please.
No, I was going to say premium finance is typically something where carriers look at those who they want to look at a certain income bracket, you should say. Typically, it's like you'll see some of them slightly a little less than this, but majority of the time I've seen like $300, 300,000 or less as far as like your annual income. What premium financing is basically, and that's something like typically if someone is like a higher net worth client, let's say a doctor or something like that, for instance, and they don't have like 401ks. So let's just say that doctor is like, okay, and this is just me giving a generic kind of layman terms, like
Yes.
for anyone who doesn't know. So let's say that doctor is like, okay, I want to put up 250,000, and it's kind of like they're partnering with the bank. So the first 5 years, the doctor, if they partner with the bank, the doctor, they don't have a 401k or whatever like that. So they're putting 250,000 in, but they partner with the bank. So the bank is also doing 250 in this example. So the bank is doing 250, they're doing 250, right? The doctor, the first 5 years. Okay. The next 5 years, and again, this is an example because same thing like how you have different policies, different makeups. This is just an example of like a premium financing makeup. The next 5 years, the doctor, he doesn't put anything else after the first 5 years. He just puts 250,000 a year for the first 5 years, along with the bank doing the same thing. So both of them are doing it. The next 5 years, the doctor doesn't put anything else. The bank is putting in 250 a year. Okay. So at this point, when we get to the last 5 years, no one's putting anything in this particular premium financing example, and the money's just compounding, is growing, is accumulating. At the end of that, the doctor then pays the bank back their initial money they gave them or whatever their agreement is on whatever interest, right? But then the doctor has, remember the statement amount, the doctor has money that he's able to retire off of now, where he has millions of dollars he's retiring off of each year just because he partnered with the bank. So premium financing kind of goes a little bit more in depth in that regard, where they're doing just that with like a bank to be able to support that, to have more income in their retirement. But it's like what I would say, the income level that would be needed to engage in those type of policies. And those are specific. Not every carrier offers that. So those are specific, where specific carriers, you have to be appointed with them. And I have one that I'm appointed with because I don't have that large influx, right? Predominantly where that is the income level. So I don't need multiple different carriers that offer that premium financing option. But yeah, that is one of the most powerful ones that you could have as well.
Okay, so in that space, so we're talking about having a death benefit of several million, maybe let's say $5 million.
Oh, absolutely. Higher than that.
Okay,
Possibly.
okay, okay. So then you have to qualify through your asset. Let's say I have real estate holdings and such. So I follow that space.
Yep.
Well, yeah, you've answered my question. You have the carrier to substantiate that, to be able to get into that space. So
Yep.
that's good.
Yeah.
Okay, thank you. Appreciate you so much.
Thank you. You're very welcome. And again, I'm so sorry it took longer than needed, but real quick, Preeti, no, husband and wife, they can't share a policy. You do need two separate policies. You can be joint owners on a policy, or have like a contingent owner if you're a husband and wife, and let's say you have your policy, he has his policy, you're the owner of your policy, he's the owner of his policy. Then you can have contingencies, like if you're not here anymore. Like let's say he owns, and I digress. Let's say that you have it's more so with like the children, where we have like the contingencies, where if you're owning, if they're not here anymore, or if you owned your husband's policy, or he owned yours and you are not here anymore, but you owned his policy and you're not here anymore, you can set the contingency if you want who else next to be the owner of his policy, or he can then take over his own policy. Same thing kind of like with the kids. If you're not here and you own that policy, who then would be contingent if they're still a minor, or letting them take it over if they're not. But since all of you are here regarding the trust, you would want your trust to own your policy. And if not own it, you don't have to make it own it, but you at least want to make your trust your beneficiary, so it can be able to receive payment in regards to like the assets for your estate. All right, perfect. And I think that's it, Christina. So the interest we pay is just whatever the government says you. No, so
Can you get another one in?
real quick, and then Laura, no, the interest that's paid is not, the government doesn't set that interest each year. It's just the MEC limit is just determined. They don't set any interest rate. The MEC limit is just determined based on what you state and your demographics. So if you, Laura, are a 30-year-old woman and you say, I want to do $250 or $300 a month, and I am a 30-year-old woman. And what happens is when we put your demographics in, we're going to see what your MEC limit is. Because if you say, Gertie, you know what, instead of 300, can I do 350 a month? Your MEC limit's going to change. So it's not necessarily a interest that's set by the government, but the limit is changed or is set by the government in a sense of, if you go over this amount, then that's where it's going to turn into a taxable vehicle. So it's kind of like they don't set it, but it's not an interest rate per se, you can say, but they don't set it. It's just something that's there, that's in place, that it's still regulated by the insurance, I would say, but they regulate it in a sense. Does that make sense? Where it's like their hand is not in the insurance. Okay. The government's hand is not in the insurance, but they put something in place. But the only way we could see it's not a set number is basically what I'm getting at. It's not a set number, because your MEC limit could be different from David's MEC limit, which could be different from my MEC limit, which could be different from Christina's MEC limit. It all is on an individual basis, which is why it's that infinite product design, and it all just depends. But that seems like it is.
That's another one.
Who was that? I'm sorry. I can't.
Mackenzie, Nikki.
Oh, yes. Okay. Yes.
I'm sorry.
No, you're
Um,
fine.
disqualifications for the IUL. I
Yes.
think one while before I heard like autism could be a disqualification.
So one of the things I always like to tell my clients is because I have some people who come to me and they already disqualify themselves without even going through the process. And I always like to tell people don't count yourself out because you never know. So I always like to do a risk assessment. What do I mean by that is I have a client who has multiple sclerosis. I have a client who has two who have epilepsy, a few who have diabetes, right? And so these are people who are saying like I've had this, or I've had a client who had cancer before, right? But there's certain stipulations. So whenever there's a medical condition going on with someone, I need to know. That's why I like to tell people don't hide nothing from me, because I had some people hide something from me, and then the insurance came back to me and told me X, Y, and Z, 1, 2, and 3, and I'm like, oh Lord. But when they tell me these things, I'm able to do what's called a risk assessment, where I just reach out to the underwriters and I just say, hey, I have a client. I don't give the name or anything. I just say, I have a client who has a child who has autism or who has this, that, or the other. Would this cause their application to be denied? And they may say, yeah, more than likely it will be, or they may say, no, it won't be denied, but it may change their table rating, which just means like where you fall on the table as far as like the cost of your premium, which means if you pay the $200 a month instead of 30 coming out, it might be 40 because of that medical condition, right? So it all just depends. So any medical condition that you have a concern about, we would always just do a risk assessment to see if that would or would not, and if it would disqualify like an application or cause an application to be denied, we would just talk about any other strategies that may possibly be available.
And that brings me to my question about the big difference between IUL versus whole life. Do you do whole life as well?
I do. So whole life, and kind of just gave you guys a brief glimpse of that before. Whole life is you can access it within 30 days. IUL you can access after a year. IUL has flexible premiums, and it also you have the ability to earn higher interest rates based off of the strategy you have, right? Whole life you earn dividends based on how much premium the insurance company had to pay and how much they actually, got back. Let's see, it doesn't have as much flexibility as like the IUL. So for me, I have a whole life and I have 2 IULs, but my whole life, to be very honest with you, I don't touch that money. That whole life to me is like my emergency savings. That's like my last resort. If I done cleaned out my IULs and I have no more left in my cup, even though my statement amount is earned interest, I have no more left in my cups. I don't have nothing in the stocks, nothing, God forbid, knock on wood. That whole life is my last resort. So I do both, yes, but I like to tell people each policy has a purpose. So when you're getting these different policies, you need to know what's the purpose of the policy that you're getting. Just like I share with my term, that one is just to keep up with my mortgage. My house is paid off in my mind. So I hope that answered it for you.
Okay, thank you.
You're welcome. And then so I think that's it. I think Christina's team dropped the link in the chat. I will like to just put a little caveat out there because of one of the things I didn't share with you guys when I started. The name of my company is Solomon Financial Solutions. It's named that because I told God when I was going to step out and leave corporate and do this thing and leave the confines and safety of corporate, that one of the things I wanted was wisdom, just as he blessed Solomon, so I could be a pitcher and pour into your glass. So that is the reason why, because I am a woman of faith. But I'm be honest, I asked the Lord when I stepped out, I said, Lord, I trust you. He will provide. It's like the Lord has been pouring so much into my cup that I've been in high demand to the point that I'm just one person. And the amount of people who are looking to work with me, at this time, I only have the capacity to work with people who are ready to move forward and be a client and get a policy. I don't have the capacity at this time to just do like consultations where if someone wants me to just answer questions for them or look over their current policies. Now, if you are like one of my clients and we're moving forward to get a policy, yes, I'll look at your other ones to make sure that, hey, you're properly insured and all of that. But I just don't have the capacity at this time as one person to take on consultations just for information, general information. So we'll get back to that point, but when we get to that point, that is something where I do normally do consultations just on like looking at someone's insurance policy or their policies or giving them an analysis on their coverages. There is a fee associated with those type of consults. But as far as doing a consultation to meet with the team and we doing your financial analysis, getting you started, getting you access to the policies, there's no fee associated with that. So it's been a pleasure talking to all of you. Thank you so much, Christina. I appreciate you.
I'm
As
so sorry. I'm extra.
oh, who is that? I can't
It's
see.
me again. It's Nikki.
Hi,
Do,
Nikki.
do you educate the hire? It sounds like you need some help, so I need employment. So, because
Oh,
right now it's summertime in the school system, since I'm like, hey, if you educate me to help you, I'll help you if you're hiring.
Nikki, I will send if you can send me an email. Let me see. I think he's in some calls now, so one of my assistants, so I'm just gonna drop my email here. If you can just send me an email with your information so I can just connect with you outside and then send you some resources so we can be able to have a discussion. So I appreciate that. Thank you. Because I am building a team. So and the way that I operate, I'm very specific because I come with the corporate hat on. I come for the corporate mindset. Um, I am very specific on how I want to build the team and do interviews and all of that. So I am interested in expanding. So yeah, give me a call, send me an email, and we'll set some time up.
Awesome.
I don't know if is that Portia, Wealth Advisor Portia? Yeah, so definitely send me an email, Portia, as well. I put my email in the chat, and then we'll set up some time to have a conversation.
Thank you.
Thank you. I appreciate all of you. Thank you, Christina. Christina, no, I always go over, and I'm so sorry because I always say, hey, I only got this much time, but then I end up moving stuff while I'm on the call and telling my assistant, hey, move this, move this, move that. Because I just feel like if you're here for the knowledge and you have your cup and hand out, and I have the knowledge, I just want to be able to pour into you while you have me. So thank you all.
We are so grateful for you, Gerda. Gerda is just like me. She's thorough. She's very patient. She has a bunch of knowledge and she's such a good educator. So I appreciate you so, so, so much, Gerda, for taking the time out of your day to come and educate all of us on these policies that we're supposed to utilize when we're living, life insurance policies. So, I have 5 policies. All 5 of my policies, two of them are trustee. The insured is the trustee, so me and my co-trustee, and then the other 3 are my 3 children. So my trust is the owner, the payer, and the beneficiary of those 5 policies. They're all IUL policies. So I am a firm believer in these life insurance policies and utilizing it as a way to preserve wealth. So thank you so much, Gerda. We appreciate you. So what I want to do now is I just want to continue Q&A. If you guys have any questions for me based off of the information that we went over today, I would love to answer your question. I know that Lanray had a question. Lanray, are you still here? Okay, so I saw his question in the chat. So his question was about counterparts. So I'll go ahead and answer that. So let me just share my screen really quickly. So he was asking about the counterparts. So what we're saying here in this agreement is that we can actually execute it in 2 different parts. Okay, so you see how there's 2 signatures that are required. So the buyer can execute this agreement independently by themselves. And then the seller can, so if these 2 individuals are not like in the same location where they can't execute the contract together, then it can be executed in 2 different counterparts. So the buyer can execute their signature separately, the seller can execute their signature separately, and then together collectively, the business purchase agreement would be fully executed. So that was the question that Lanray had in the chat about the counterparts. So we have Daniel.
Hi, Christina. How are you doing today?
Fantastic, and you?
Well, I always catch you why you kind of look like you're tired and worn out. But I waited for you.
Oh, was I supposed to take that as a compliment?
No, it was. It's just that I always come in at the end. It wasn't you're very patient. So I always catch you at the end. And I
Oh
feel
yeah,
bad because I'm looking at you. I'm
oh
going, wow.
we've been here for 4 hours, so we are about to wrap it up in the next 30 minutes. We're gonna wrap it up because we're creeping into that 5 hour mark.
Okay, well, I had waited patiently. You told me to wait
Yes,
till
sir.
today to ask you this question, right?
Uh-huh.
So, 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 the question I had asked you originally was, can you use one of these entities to, or maybe I should ask you this way. How would you suggest I purchase a piece of real estate from an investor? I'm normally using a land trust, right? So I was asking, could you just use one of these entities to purchase without having to go to the title company, or you still have to go through that process?
So, I mean, I recommend that people use title companies for
Hmm.
for sure, because they do the due diligence for you. So if you don't want to, you can, so you can have your own agreement with the seller, and you can use the unincorporated business trust in order to purchase that land or piece of property.
What would be the recourse on doing that? If you did that, what's the worst that could happen if you did it like that?
S- So, like what you can do is you can, I mean, I personally wouldn't purchase any property without using a title company and
Okay.
doing my due diligence. So, I
Nope.
mean, there's so many things that can happen. I can't even begin to explain it, okay?
No, no, I
Like
get it.
there's liens on property. Sometimes, just like I mentioned earlier today, where there's deed fraud. So there's so many things, and that's why I would leverage a title company.
Okay. No, no, I get it. I get it. I just didn't know if that would replace it if you quit claim deed, if they quit claim deed the property to the unincorporated
You
business
still,
trust.
yep, they would. So the business trust will own the property. If it was the rightful owner and they did a quick claim deed, then you cut out the middle person and now the trust is the owner.
And what about the due on sale clause? Would that would that offset it, or the due on sale clause, could that cause an issue there?
That's a wonderful question. So if there's a mortgage on the property, as long as you transfer the property into a trust, then it doesn't cause the due on sale clause or the acceleration clause.
Last thing. So that I was telling you in some transactions I've done recently, they've been asking, they'll like the insurance company will ask if they can see that who the beneficiaries of the trust are. We went over that earlier when you were talking. They're not really allowed to do that, right? You gave some examples.
So they can do that. Yeah, they
Oh,
can
they
ask.
can.
Yeah, they can ask, and it's up to you if you want to provide it or not. If you don't want to provide it, just let them know that they're invading your privacy rights.
Hmm. Okay. I appreciate your patience.
You're welcome. Next we have Lydell. You're still on mute.
Now I'm trying to find a microphone. You know, you got.
Absolutely.
Thank you for taking my question. And
Yes, sir.
mine is real simple. I just wanted to. Can you elaborate on the quick deed and it said county, state, and to wit? What does to wit mean?
So we're just referring to the legal description. So that's what we're saying. So we're just describing what the property is.
Okay. Thank you very much.
You're welcome. Next, we have Will.
Thank you for taking my question. And when you with your trust on the asset inventory, you're you're pretty much giving all your information, your passwords, and to your bank accounts. So where would you recommend storing your trust?
Oh, that's a good question. Hold on one second. So I recommend that everyone have a trust binder and that they keep their trust binder in a secured location wherever they are. So like me, I have one copy here in my primary residence and I have it under a safe. So under a code, under a safe. And so this is where you want to house your trust documents. So like I have all of my indentures. I have my titles, I have my deeds and everything like that. So what was your question about the asset inventory? So you would house it in your wherever you have your trust documents.
When you purchase the binder?
I cannot hear you,
Oh,
but the last thing I wanted to tell you was that the asset inventory list is um it's a part of your internal record. So you're not sharing that with anyone because all your private information is on it.
can you hear me now?
Yes.
Okay, thank you. Could you post the vendor that you use to purchase the binder? You use a
Yes.
particular vendor? Okay, I appreciate that.
You're welcome.
And then my second question is when you're transferring when you're transferring property using the quitclaim deed and you're transferring it to your holding trust company, if I'm a member of my LLC, managing member, and I'm signing off as the seller, and then I'm the trustee of my business trust, it would be the same signature. Is that
There's only one signature that's required, which is the seller's. Is that what you're talking about? The deed?
yes on, yes on the deed, correct?
There's only one signature that's required, which is the seller's.
Okay. On the transfer of a vehicle, it's the same scenario where as the seller, I'm the owner of my car and then I'm transferring it into the trust and I am the trustee.
That's correct.
So they are seeing that really I'm still the same person. So there's exposure there.
Right.
It's,
So
it,
that's going to be internal with the DMV.
okay. Okay. And then on the business purchase agreement in section three. Yes, it's section 3. You talk about with the corporation when you're transferring shares with unlike the LLC, LLC you can transfer 100%
Correct.
ownership, but under the corporation you have to one person has to keep 1%. Could you elaborate on that?
Yeah, so it's just based on the guidelines of a corporation. There has to be a natural person that is a stakeholder or a shareholder. So that's the nature of that entity.
So a corporation is has to fall under those guidelines of having remaining at least 1% as a natural person.
Correct.
Okay, clarity. Okay, thank you so much. I appreciate you.
You're welcome. All right, next we have Lynn.
Hi, thank you. I'll make this very quick. So on the business purchase agreement, when you put the buyer down, that's the trust. So you put the trust name, but then I would also put my name and then put TTE after that as the buyer.
So you don't have to put your name, but you have to be the authorized signatory for the trust. So it would be your signature, whatever signature that you choose to use. And then
Okay.
you put your title.
Okay. And then as the seller, I would just use my name, right? So my name would actually be on there twice, and that's okay.
It is. It is
Okay.
okay. Yeah,
Okay. I just wanted to.
it's not a conflict of interest for you to, sell it to another entity that you have interest in.
Okay, great. I just wanted to make sure of that. Thank you so much.
You're welcome. All right, next we have Denise.
Hey, Christina, I just wanted to know when do we get the replay for all of the videos that for all of your recordings for this week?
Oh, that's a really good question. So, do you have your login credentials for the online portal?
Yes, I do.
Okay, so when you log in, you're going to see two different sections. One says workshop training recordings, and then the other one says wealthy trustee program. So you have to go to the one that says workshop training recordings, and then once you click in there, you're going to scroll all the way down to the bottom. We'll have the latest workshop, which is the one that we're in right now. All right, thank you. Next, we have Gary.
Oh, hi, and thank you for taking my question.
Yes, sir.
It really pertains to yesterday. The LLC should be owned by the trust. From what I understood, it's easier to get funding for the LLC. That's what I'm looking to get funding for the trust. So if the LLC can get funding and the trust owns the LLC, then I should have funding available, right? Through the trust.
So every entity is different when it comes to funding. So if the LLC has funding, it doesn't automatically mean that the trust has funding. It's a separate entity. So it is easier to get funding for an LLC.
Okay, but the LLC is statutory.
Mm-hmm.
Uh-huh.
Yeah,
And
you should use an LLC for funding purposes because since they're able to look it up on the public records and on the Secretary of State, that's why it's easier for you to be able to get funding for that entity. So if you already have an existing LLC, which it sounds like you do,
with the
then
bank account, yeah.
yes, sir. Yeah, so you should use that entity versus dragging your business trust into the public and causing it to get funding.
Right. So just let the business trust own the LLC.
Yes, sir.
Okay. I'm a little slow, so I plan to get everything done. And
You take your time, Mr. Gary. I always tell
yeah,
people take it one step at a time. You have lifetime access to the workshop, so we want you to be able to come in whenever you're available so that you're able to hear this information all over again so that it helps with retention.
one more question. With choosing the name for the trust, am I considering, I don't want to put it with the state. So as far as getting, like just for instance, my faith-based organization would be the Good Samaritan. Although I looked on the state record and there's already a bunch of stuff there for Good Samaritan, I might not be able to get a website or I might not be able to get the domain name. Does that matter for the trust name?
No, you can use whatever you can use whatever name that you choose.
Okay. All right. Let's go and then what else? Okay. I think that answers pretty much my question.
All right, Mr. Gary, thank you.
Thank you.
All right, next we have Pretty Serious.
Hello.
Hi.
I have a clarification. I'm going to say a statement and you let me know if I'm right. So I have a business that I opened up 2 years ago, but I've never really done anything with it. I just got my EIN number and it's an LLC. And so it has my old address and my old name. But when I'm going to register it with the Secretary of State, I'm going to put my registered agent when I get one and then my trust information. So I don't need to do the transferal. I'll just put that originally because I've never even opened up an account with the secretary yet.
Okay, I'm just trying to get some clarity here. So you said you have an old LLC, and are you trying to amend that old LLC? Like, is it active or inactive?
It's never been registered, so it's
Oh,
technically
so
not.
it's not an LLC.
Well, it's not been registered with the state, but I do have an EIN for it for IRS.
Yeah, but an EIN doesn't matter though.
Okay,
You actually have to form the LLC through articles of organization. If you never did that, the LLC doesn't exist.
Okay, so then it's a brand new business.
Oh, absolutely it is. So the wonderful thing about you not forming those articles yet is that you get to do it right the first time. So you're going to do your articles of organization and you're going to choose an entity like a corporation or another business to be your registered agent. And then you will have your unincorporated business trust be the authorized member. So that's fantastic.
And can that entity be one of my trusts?
Yeah.
Okay, awesome. And the other question is, I'm opening a faith-based organization business. So a 508c1a business, and I have the EIN for that, but I was under the impression I don't need to register that with the secretary.
You don't. You don't have to register any of your trust.
Okay.
Yeah, you don't want to. You want your trust to be private.
Okay, and then I went on to the state of Tennessee, which is where I reside, and it told me to create an account. Do I put my personal information in that, or do I keep it trust information?
So you want to create it under the entity's name.
Okay.
So it sounds like you're going to be forming an LLC, so put the LLC information.
Okay. Okay, I will do that. Thank you so much.
You're welcome. All right, next we have Miss Marilee.
There we go. So I'm having an internal conflict with all these agencies and using a virtual address because they all have my real address, like the DMV and the Secretary of State. So will a notary still verify that?
So you said, will a notary still verify that?
Well, I just feel like I'm creating fraud if I do all these things and then I don't.
So Miss Marilee, you have to understand that the trust is not you. You are going to continue to use your address under Marilee. The trust is not you. The trust needs its own address. It is perfectly legal to use a virtual address. If it was illegal, then we wouldn't have so many companies that offer those services. So, in order for you to use a virtual address, you do have to have a notarized form because of the USPS being a government agency. So there's no way, shape, or form that you're actually committing fraud.
Okay. Okay. So everybody does it, right?
It's more common than you can imagine.
Okay. I just was having a little internal conflict with that.
No, so so for example, if you're using your personal address with the DMV, there's no reason for you to change that, right? But you're not the trust. So the trust is going to use its own address.
Okay.
That has nothing to do with your personal address under Marilee.
Okay. Because I know the bank that I probably want to use, they've got all my accounts basically right now.
Yes, but the trust is a
Trust is not
separate
me.
entity. Yes, ma'am. I know it takes a mindset shift. Please give yourself time. That's why I just mentioned that just take it one step at a time because sometimes we don't realize that the trust is a separate entity. You gotta look at the trust like an actual person, right?
Okay.
It has a name, it has a date of birth. It has, you know, an EIN, which is equivalent to a social. That's like a newborn baby. So
Okay.
that is not you. So that's the way that you have to treat it. So does the trust have an address? Yes. And it doesn't share the same address as you, just like a newborn baby, right?
Okay.
It can very well have a separate address from you.
Okay. All right. Thank you. That helps.
You're welcome. Yes, absolutely. Next we have Shonda.
Hello.
Hi.
I have two questions. First question, banking. Um, since is the business trust And the LLC, is that the same account, bank account, or different? You need two different accounts.
Miss Shonda, I'm going to ask you a question. Is the LLC and the business trust the same entity?
No.
Okay. Would you, so you want them to have separate bank accounts, and the reason being is because you don't want to commingle funds. So LLC income is LLC income. It goes into the bank account of the LLC. So just because the business trust owns the LLC doesn't mean you're going to share the same bank account. You want to keep the LLC's bank account intact.
Okay, I just wanted to be clear on that.
Yes,
I
ma'am.
was pretty
That,
sure, but I
that was
wanted to ask the question to make sure.
yeah,
Maybe somebody else
that
was
was
thinking the
a
same thing
fantastic.
too.
Yes, ma'am.
And my second,
Yes,
um,
ma'am.
I have a LLC and I'm not using it, and it is registered. Well, it was, but it's inactive. Do I need to reactivate it before um, I turn it over to the trust?
Are you going to continue to use that LLC?
Yes, I'm gonna use it.
Yes, you do have to activate it. So, because the LLC is a statutory entity, it's regulated by the state, and you cannot operate an LLC that's inactive.
Okay, I just wanted to know, do I needed to reactivate it before I do it, or I can do all at once?
So, you have to reactivate it
First.
prior to the amendment.
Okay, okay, okay. Just wanted to make sure so I can
Yes,
know what,
ma'am.
yeah, I wasn't using it and I'm like, okay, instead of me go ahead and just get a whole nother one when I have one that I can just use, I'll do that. So
Yeah, and then you can use it for funding purposes. So
yeah,
that would be awesome.
because it has some years under it, so have a couple
Yes,
of years.
exactly. And that's also a good thing that when you are showing credibility for funding purposes.
Okay, thank you.
You're welcome, Ms. Shonda. Next we have Nikenji.
Can you hear me?
Yes, ma'am.
Okay. Because I just thought about what she was talking about. She would need a certificate of compliance for that, right? To get it back active.
It depends on the Secretary of State.
Oh,
So yeah, every Secretary of State is different. Their forms, their paperwork, everything that they are going to ask you for. But whatever paperwork that the Secretary of State requires in order to reactivate the LLC. So I've been in that process before, and I just filled out a form, and it just took like a week to process, and they just renewed it.
oh, okay. Well, that wasn't really my question.
Okay.
My thing is, I'm clear that each entity needs to have their own bank account, but a business trust and a LLC under the business trust, they can share the same um virtual address though, right?
They can.
Okay. Is that not a good idea?
No, it's perfectly fine.
Okay, because I'm trying to save my pennies.
Yeah, absolutely.
Yeah.
That's why I said do what you can. Like because it can get a little pricey. $10 here, $10 there, $10 here. Absolutely.
Thank you. I just want to make sure I was clear on that.
Yeah, absolutely. Let me see. Okay, so Jared says if someone never registered a car with the state but had a car for years, I don't understand how this question is applicable to me, so I can't even begin to answer this question. I do not know. So
I have
I would contact the DMV so that you could register the vehicle. Next we have James. I think I heard somebody's voice, but I don't know who it was.
me pretty serious.
Oh, okay.
Last question.
Oh,
Um,
yes.
about phone numbers, a virtual phone number. So I have a Google Voice number for OneTrust. Can I use that same number for everything, just so everything comes to my phone?
So I would use separate everything for, these are three separate entities, so I would use separate stuff. If you want to combine it, you can, but no, I would. So I would create a Gmail account for each trust. I would create a virtual address for each trust, and I would create a virtual phone number for each trust.
Okay, perfect. All right, thank you.
Mm-hmm. You're welcome. James?
Right. Christina, yeah, she pretty much answered our question on the last one about the because I thought in one of the previous workshops somebody mentioned something about for the ministry trust that you can use the same address as the family, to save a little
Yeah. So
money.
yeah, I always tell people you want separate contact information. If you want to be economical, then whichever trust you're not going to have as public facing, meaning typically you're going to have the business trust be public facing. You're either running a business with it, you're using it as a holding company, or you are building credit. Okay. So you want that trust to have totally separate information from the other trust that you're using privately. So if you want to go the economical route, then you can definitely use that strategy.
Okay, thank you. And then as far as the family trust, do you I know you say you could build obviously credit with the different trust. Should you recommend registering that with the state on the family
No,
trust?
no,
Okay.
never. I don't think that you should register any of your trusts with the state. It doesn't make any sense.
Okay. Thank you.
You're welcome, James. Next we have Will, and then we have Daniel, and then we're gonna wrap it up for today, everyone.
Answering a question, could you please distinguish between the statutory and non-statutory in that having an LLC to get financing, why it should be statutory, please?
So, I think that Brian mentioned it yesterday, but you have to understand that when it's statutory, right, you are registering it with the Secretary of State, okay? And you have state statutes that are embedded inside of the Articles of Organization for that LLC. And so these funding companies, they want to be able to look up your business, right? So they want to be able to go to the Secretary of State and see that you have, the name and that that the name of the entity as well as your name being listed as the authorized member, right? So if they're not able to verify it on the Secretary of State, then they're going to ask you for more documentation. Okay. So that's why some of these lending institutions won't even lend to a trust. So I always say this, right? It's easier to get financing with an LLC. So if you have 100 banks, right? With an LLC, you can get funding or credit with all 100. With a trust, you can get funding and credit with 10 to 15 out of the 100. And that is only because it is statutory and they're able to go in the Secretary of State and verify, right? And so the only reason why that whole process is like that is because the state regulates the companies, right? So that's why that is. And it's up to, their funding guidelines, these banks and financial institutions. So that's the main difference. And I know that Brian had touched on it yesterday. So they just ask you for more documentation. And so more documentation could very well be that they're going to ask you for the entire indenture.
The trusts that we create are non-statutory, correct?
Yeah, they're
Or
non-statutory.
non-stat.
They're non-statutory, so they don't have any state statutes and codes, and they're private, so no one can look them up on the Secretary of State's website. So you're gonna have to provide more documentation.
Thank you so much for answering that.
Okay, we have Daniel.
Okay. So if I went ahead and did it through, I'm just asking you a question about purchasing the real estate. So is it best for me to go ahead and do it the way I've been doing it, like through a land trust, and then make the beneficiary the one of the new entities, or does that make sense?
That's a strategy that you can use.
What would you do? Purchase it in one of the new entities? I'm just asking for you, what are the options?
So you want an answer from me so bad. Like there's hundreds of different strategies. So I would purchase it in a trust. So it doesn't matter if it's a land trust or if it's a business trust, you're still purchasing it in a trust. So the only difference is that your land trust is revocable, correct?
Correct.
Okay, so with a revocable trust, it doesn't protect the land. It just avoids probate. So if I was you and you are having all of these concerns, I would do it the way that you've been normally doing it. And then once it's in your land trust, you deed it over from your land trust to your business trust.
I see. I see. Okay. I appreciate you
You're
very much.
welcome.
Thank
You're
you.
welcome. You know how there's like 20 different ways to get to the same address?
Right. No, no, you know what? You're right. I just wanted to make sure, since haven't done it this way, I just wanted to make sure that if I did it that way, I did it right. That's it. I know
Yeah.
I sound redundant. I keep coming back at you. I know you're about tired of me. Yes, I get it. But I just wanted to make sure I did it right, Christina, you know?
I know. Yeah. I mean, just do it. Like, if the way that you're doing it is not broken, just start it off that way and then ultimately know that it needs to end up in the irrevocable.
I see.
Yes, sir.
Thank you, ma'am.
You're welcome. All right, guys. So we're gonna wrap it up. Um, so two things. One, I want to tell you what your homework is. Your homework is we are going to send you a survey. So in the survey, we want to know what your experience has been here in the workshop. So it should already be in your email because we thought that the workshop was going to end at 2 o'clock. So it should be in your inbox already. So if you could fill out that survey, that would be very, very, very fantastic. The next thing is that me and the team, we will double check your documents before you get anything notarized. So if you want to book a call, you can book a call so that we can double check everything that you have. So we'll be able to help you cross your T's, dot your I's before you finalize any of your documentation, okay? The last thing is I want to know if anybody would like to come off of mute and let us know how their experience through this 1 week workshop has been, because we are always wanting to improve our process and how we run the workshop. So if you could give us some feedback, that would be fantastic. So does anybody have any final words or anything that they would like to say regarding their experience here during the workshop this week? I see Will has something to say.
I will say that this has been the most profound class seminar that I've been in. I thought that I had skill sets, but you've taken it to the moon. And Queen, I so appreciate you. I met with an attorney yesterday that has he does trust, and I started breaking things down to him about irrevocable trust, and he looked at me like, he said, well, you need to take some, maybe, you can work as a trust administrator in my office. So I just want to say to you that I've worked with a trust company for the last 10 years, but I get chills, and I just so am humbled and so appreciate your brilliance, the God brilliance that God has given you. And thank you for being open to share it. I'll tell everybody on this call, that to get this information is priceless. So I am sincerely humbled, and I thank you. Much gratitude to you and your staff and all that you do. Many blessings. Thank you.
Thank you, Will. Oh my gosh, you put the biggest smile on my face. That means the world to me, Will. Thank you so much. And it just comes from 10 years of experience of me operating my own trusts from 25 to 35. And I'm just teaching you guys what I know. And this is something that God shared with me in 2021. I don't tell people this, but in 2021, I lost my mom to COVID. And 6 months after I lost my mom, God was sharing with me. I was in pieces. I was in shambles. I was in pieces. I pretty much lost all of my marbles here just because I lost the most important person in my entire world and existence. And so I ran straight to God so that God could put me back together. And God told me to start sharing the ministry trust. So the way that it started was me sharing the ministry trust. And then I quickly realized that I had to share the entire structure because I'm like, God, like, I know you told me to share the ministry trust, but like the people need all of the trust, right? They need the business trust, they need the family trust. And so that's how it kind of unraveled for God to put me in this position. So I am walking in my God-given mission and purpose, and I'm heavily protected in that purpose. And I know that every single person that is attracted to this community is it's spiritual and you guys are sent by God. So, and I hear it all the time where people they say, "Oh, I was just thinking about it and you came across my channel or my page or out of nowhere it just came on my lap and everything." And I said, "Yeah, it's God moving in moving in our lives because of obedience, because I have been obedient and you guys are also obedient." And so I always tell people, I said, God is my business partner. So this company is anointed. So, but thank you so much for saying that, Will. Thank you. I appreciate you so much. So thank you for being a part of the community. Next we have Lydell.
Yeah, I just want to piggyback on what Will said, and once again appreciate all that you're doing for us and helping us to come up to new heights in the life. And I want to, help our people as well. So me and a friend of mine named Glenn, and he has the course also. We have been searching for, quite some time trying to find someone because they've been skirting around with a little bit of this, a little bit of that. And so he came across your channel and he was like, "Hey man, I think I found the person who's going to really help us out with this." And I really agree with him that you have helped out a lot and brought forth a lot of clarity that everybody else had cloudy for us. So once again, I'd like to thank you and also appreciate the fact that we have lifetime access because sometimes we might not remember some things, and it's great that we can go back in and refresh and grow even further. So thank you once again.
Thank you so much, Lydell. Thank you for saying that. And I'm just so glad that you took the leap of faith and you joined the community and you are getting the clarity that you've been looking for. And just know that we are here as a resource for you. So whatever help and assistance you need, you are, more than welcome to reach out. And then it is so beneficial to have lifetime access because like half of the people that are on the call, they joined last month, the month before January. Some people are from last year, the year before, the year before. And so it's just it's very nice to be able to jump in and jump out and have that refresher. And then for us to just build a community together. So we have almost 1,100 trustees in the community. So just stay connected. And I'm so glad that you're already connected with Glenn and then just, connect with the rest of the trustees because we can learn a lot from each other and we're here to empower each other. So thank you so much, Lydell. Appreciate you being here.
And one more thing,
Yes, sir.
I've sent out your link to the boot camp to so many people.
Thank you.
continue
Yeah.
about you as well.
Yes, thank you so much. Another thing is that we have an affiliate program because we want to be able to give back to you guys that are are referring us. So if you're not an affiliate, please sign up as an affiliate so that you can get credit. And if anyone that you sent the boot camp link to, if they sign up, just send us their name so that we can send you the commission that's owed to you. And so that's, for everyone. If somebody referred you, just let us know because we want to be able to send them a thank you. That's what we believe in. So,
Awesome.
for you helping us grow this community because we just want to impact as many families as possible. Thank you. Next we have Shannon. Hi, Shannon.
Hello, Christina. Hello, everyone. I just wanted to say, I work from home and, every time you're on, I log in and I listen. And there are things that I hear and then it clicks for me. So the more you listen, the more it reinforces your learning, the more you'll understand how things connect to each other and how to use it and teach your family and have them involved so that they know that when you're no longer around, that they have that foundation, because you're not building this for nothing for them to blow it, because they have to know how to have their family in trust, and to create the documents that you created. So I appreciate you. I appreciate, everyone, the chats, that Telegram group. We stay in touch with each other and just thank you for your time and your patience and you explaining everything to us in layman's terms as well as, in the trust speak, because you have to know it both ways. And you give it to us in both ways so that it connects with us. So thank you so much for everything.
Thank you, Shannon. I just appreciate what you're saying. And it's so important that for everyone to know that we're building this legacy and we need to pass the baton. So as she's mentioning, it's going to be up to us to be able to educate the next generation. And so allow them to go through the same training that you're going through so that they can start preparing now before they take on, this big role as a successor, trustee, or trustee. So thank you for saying that, Shannon. Shannon, you're a nurse, right? In New York?
Yes, I am. Yep.
Yes, I remember we had a conversation a couple days ago.
Yep.
Yes, yes, yes. Okay, awesome. It's the voice. So thank you, Shannon. It's so refreshing to hear your voice again.
Thank you.
All right. Next we have Nikenji.
Hi, I just wanted to say thank you. I'm very happy that God is giving me this purpose, and I just pray God to give me my purpose. And I don't know, I've been, well, you don't know, I've been substitute teaching, and so towards the end of the year, I've been giving kids information on credit. They told me it's life skills, and so they're having them read paragraphs and underline verbs. I've been giving information on credit. I know one day I put on a video on trust, another day information on IULs and things like that. So, they don't teach that kind of stuff in school. So I was like, I started writing up information for the kids, like on credit. I haven't did anything with trust because I'm still learning about trust. But I was like, I was giving that to them. I was like, well, I think I might try to do an ebook or something like that. So, you know, I just hope that, I can help give somebody else some more information and get it sooner than I did. And
Yes, and that
thank
is so
you.
powerful. Oh my gosh, Nikenji, that is so powerful. And that's what being a generational curse breaker is all about because now you're impacting those children so that they can start off life the right way, right? A lot of us, we didn't, unfortunately, we didn't have the financial literacy that we have access to now. And so we didn't have, IUL policies and brokerage accounts and all of those things we learned, in our late 20s and 30s. But now that you are put in the position to impact the youth, that is absolutely phenomenal because you're going to assist them with breaking those chains of poverty. So that is so, so, so phenomenal. I'm so glad that you are, doing what you're led to do. Thank you, Nikenji, for being a part of the community.
You're welcome. I just hope the kids take it in some of it because I was like, asked one kid a question. I just said, don't put my head down. I was like, were you listening at all? Did you read it all? At
Yeah.
least it won't be this first time they heard it. Hopefully they'll catch it somewhere.
Yeah, exactly. I know. I hope so too. And a lot of these, like a lot of the youth, they should be learning this stuff starting from middle school, high school, even college. A lot of even young adults, they don't have access to this information. So I just appreciate what you're doing because you don't know how you're impacting them, but you'll be able to, those seeds that you're planting right now, they're going to bear fruit. So thank you, Nikenji. Next we have Lanray. Hey, Lanray.
Hello, Christina. How are you?
Wonderful, splendid.
I can say so much right now, but uh, by existence, we have a huge gap between us. But you really took me something like a baby. I feel like a baby listening to you every time. And you, uh, you have seriously impressed on me how lifelong learning, how much lifelong learning could do to you. And with everything that I've learned in these few days, you bring me up into the space where I see myself teaching this to a group. I see myself preaching this like a sermon. I just want to pay it forward by every means. You have blessed me so much. I only met you about 30 days plus ago. And to this point, I just want to stay connected for a long time. And for y'all in the room, she's not only an American citizen, she's a Nigerian citizen too. Uh, she's from my state, so she's got a connection with motherland. So anyone want to connect, she's your source as well. And I'll give you a citizenship for Nigeria if you want to come to Nigeria.
I do want my citizenship. Akure?
Yeah, correct. So I
Akure.
want to thank,
Yes.
yeah, I want to thank you so immensely. You are a light, and this is not to blow the horn, but you are indeed a light. And I pray God, Yeshua, continue to make you shine. And I want to congratulate every member of this group as well. And I pray that Yeshua impress upon you and give you the positivity, the encouragement to launch forward and to be established indeed. Thank you so much.
Thank you so much, Lanray. I appreciate that so much. Everyone, I met Lanray at a real estate conference last month. So it was about 4 weeks ago, and like it was just such a beautiful interaction in person between us. And now, he's a part of the community and he's attended the workshop. And so I'm here to be a resource, a guide, a helper, whatever it is that you need. I'm here for you, Lanray. So thank you so much for taking that leap of faith. Thank you so much for, putting yourself in a position to where you're like, yeah, I want to get access to this information because now it's time for me to walk into this space of entrepreneurship. So I'm here to support you every step of the way, Lanray. Thank you, thank you, thank you, thank you. And I know you're going to add a lot of value to the community because you're so smart.
Thank you.
Thank you. Next we have James. Hey, James.
Hey, one more quick question. How do we go about scheduling a one-on-one call with you? I'm getting
It
near the end
the
of
the the link is in
wrapping up
your
my
email. The link is in your email.
Okay.
The link to the calendar.
Okay. Gotcha. All right. Thank you.
You're welcome. Next we have Wealth Advisors. Is it Portia?
Peace and prosperity. Yes, it's Portia.
Ooh, that's beautiful. Portia. Excuse
Thank
me, I stand
you.
corrected, but I won't mess it up again. You're the
No,
only
you're
Portia.
fine. You're
You're
fine.
the only Portia I know.
Really? Well, this is so divine. I just really wanted to just thank you so much for all of your wealth of information that you are providing. And this workshop has like exceeded all my expectations. Just hanging my license with a wealth management firm and studying trust on my own for like almost the last 5 years. This right here is so incredible. I just want to thank you for just being in alignment with your assignment with God, because I know this is divinely connected to my purpose. And you have put all three trusts that I've been doing individually all in one. And I just knew that all three needed to work together. But studying it with different individuals for so long, the reason why I never pulled the trigger on them was because the way how you have it structured is what the three trinity of what God's alignment is. So I just want to thank you for just being so in alignment with your assignment. It just gives me chills every time. And I just cannot wait to actually refer all of my clients now. I have some place now that I feel comfortable referring all of my clients now with you, because being in this space, you see them doing it, but they already have who they want picked. But in my industry, it's not a lot of us in our industry. So I just thank you so much for just being so purposeful. So with all your wealth of information. So I can't wait to connect. And I did have one question. Can I use the UPS address? Because I do have a UPS address for my businesses in my
Yeah,
trust.
yeah,
Oh,
you definitely can.
okay.
Yeah, as long as it doesn't start with P.O. Box.
No, it doesn't.
Okay, that's
Okay.
perfect. Yeah, but thank you for saying that. Alignment is so important. And so I'm just so grateful that that like all the pieces to the puzzle are finally put together, because that's what we want. We want to be able to empower people, and it sounds like you are empowered in order to, make the necessary steps forward that you need to make now that you know that these three trusts work together collectively. So I'm just so grateful that you're here. I'm so grateful that you mentioned that you would like to refer your clients. So definitely go ahead and get into the affiliate program, because we want to be able to give you credit for that as well. But I am, I'm so happy that now you are here in the community. So whatever wealth of information and knowledge as an advisor that you want to pour into our community, because you know that our people are in that space where they want to be able to acquire that knowledge, please do so, because that's what we're here for. We're like-minded individuals, and we want to be able to work together and network with each other. So thank you.
Yes, thank you.
You're welcome. Next we have Kiana.
Hey, Christina.
Hi.
I got a question. Is
Yes,
it
ma'am.
okay for the notary to be a grantor?
No, it's a conflict of interest. The notary cannot notarize their own signature.
Okay. Okay, cool. Thank you.
You're welcome. And next we have Ms. Marilee.
I thought I lowered my hand. I'm sorry.
Oh, it's okay, not a problem.
Off the hook.
Next we have Daniel. Daniel, you're still on mute. Do you have something that you would like to say? All right, next we have Rich.
Can you hear me now? I'm
Oh yeah.
sorry. I pushed I just wanted to tell you, I prayed about this, okay? And I just want you to know, you you leave me speechless. I meant what I said to you the first time I spoke to you. I said, wow, that bedside manner that you have, it's it's angelic, it's divine. I mean, and you are I gotta tell you, you are a consummate professional. You are the tip of the spear. I mean, I've been around professionals my whole in life in the corporate world, and I'm not joking. I have yet to meet someone of your acumen and your thoroughness. I mean, normally I wouldn't even speak in something like this. But you, I mean, you're just amazing, Christina. And I just want you to know how thankful I am that, and you've been patient. I keep coming back with this. You're so patient. I love you, Christina. I mean that. And I want to be a blessing to you too. And so I just want you to know I'm really grateful. Normally I wouldn't have even stayed on here. It's you. You are just, you're amazing. You're amazing. My condolences to you. I know what it means to lose the most important. I lost my father, so I know what it means to lose the most important person in your life. Um, but I'm grateful. I'm so grateful. You leave me choked up, but you are, you are it, girl. You thank you so much. I really appreciate you.
Yeah, thank you, Daniel. Thank you.
Absolutely.
You put the biggest smile on my face. Oh my God. And the fact that you said bedside manners, like that is the truth. If it's not, oh my
It is.
yeah, oh my gosh. Thank you for saying that. Like, yeah, I don't know. I'm a nurse at heart. I'm a nurturer at heart. I'm an educator at heart. So I just cannot help it. I really can't. And that's why I can't even end the calls on time. We're supposed to
I
end at
know.
2 o'clock. And I'm like, no, let's keep going. Let's keep going until the last hand falls.
You're the best I've ever seen, Christina. Keep doing what you're doing.
Thank
And I
you.
really mean that. I want to be a blessing to you too. And I'm gonna pray about that. I'm gonna join the affiliate program, right?
Please.
But thank you so much. Your manner is infectious, and I mean it comes through like loud but soft. Thank you
Thank
so
you.
much. I really
Oh,
appreciate you.
you left me speechless. You said I left you speechless. You left. Yeah. And you have all those real estate questions, so you need to be letting us know what the play is, okay? You need to put it in the Telegram chat and the Facebook group, okay?
Yes, ma'am.
Pour into the community. Thank you.
Always,
We have
Christina. Hmm?
we have a lot of real estate people that are going to be doing master classes. So next week we have Abdul Shabazz. So he
Hmm.
runs the company called the Mobile Home Closers.
Hmm.
So he's going to come in and he's going to teach you guys how to buy, fix, and flip mobile homes. Cash flow.
Oh, yes. That's
So
beautiful.
so stay tuned for all the master classes that we have coming up, you guys. So you're going to get the text message, you're going to get the emails, and then you're also going to get the announcements on Facebook and Telegram.
Just one more thing.
Yes, sir.
I've watched so many of your videos, right? And so you had mentioned something about overseas purchase. You were going to be putting something together. Do you recall what that is? When you were
Uh-huh.
saying, right? I want to know when you get that ready. I'm be looking forward to that.
Exactly. Coming soon to a
Coming
theater
soon.
near you. Yeah, exactly. It is. I can't say too much until everything's executed.
I get it. Thank you
Yes.
again. Thank you
Thank
again.
you.
It's always a pleasure.
Thank you, Daniel.
You're welcome.
Next we have Rick. No, Rich. Rich. I'm sorry, Rich. I thought I saw K.
Hi, Christina.
Hi,
There's
Rich.
no words to say thank you, thank you, thank you for all this wealth of knowledge that I learned. Yeah. I have a question on all this trust. Can we use it all overseas?
So it depends on the jurisdiction. So it depends on where you want to use it and what their laws are. But these are domestic trusts that are designed to be used in the US and US territories.
Only. I
Yeah.
see.
Yeah. So we I am currently working on I've partnered with a company and I'm going to make available to you guys an international trust. It's going to be definitely this year in 2025. And so those of you guys that are already in the program, you're grandfathered in and you get full access. So it's going to be uploaded into the program once it becomes available. And that trust is designed to be used in every jurisdiction in the world. Okay.
Oh,
So
wow.
yeah, it's powerful. It's when I tell you, so a trust entity is the most powerful entity in the world, and then the international trust can be used in every jurisdiction. So it will be available to you guys very soon. Definitely by the end of the year, okay?
Awesome.
I have a
Awesome.
question. Is
Very
that a
good.
98 foreign grantors trust?
No,
No? Okay.
no, it's definitely not.
Okay. I'm looking forward to it.
Yes, yeah, it's an international trust. It is, well, I don't want to say too much, so just allow me to put things together for you guys, okay?
All right. Thank you so much.
You're
And
welcome.
Christina, my next question is, I'd like to ask your opinion. I'm holding some exotic foreign currency and bonds. Uh, what's your opinion if I put that in the family trust, or is it better to be in a business trust? Because uh, those those currency and bonds can be exchanged to US dollar that would have a large appreciation. So, what do you think of that? Is it the family trust or the business trust would be better?
I would put it in the family trust. I wouldn't put it in the business trust if you're using the business trust as a holding company. And you also might want to consider just creating an individual trust just for that.
Just for that, huh?
Yep. Just isolate it.
I see.
Yeah, it sounds very unique. And so sometimes we just need to put ourselves in the mindset that we need multiple trusts within our structure just because of the different type of asset classes that we have. And sometimes they shouldn't all be together in one trust.
Okay, got it, got it. Well, thank you,
You're welcome.
thank you for the information and answering all my question, and thank you so much.
You're so welcome,
I'll
Rich.
mute
Thank
out.
you. Okay, awesome. Then we
By the
have
way,
Paul.
sorry. By the way, one more thing.
Yeah,
Could
yes, sir.
could you repost that supplier for the binder, trust binder?
Yeah, I have to. Yeah,
It's
let me grab it. I'll put that in. And then also I will have Angelica put it in the Telegram. Are you in the Telegram?
I I gotta sign up again for the Telegram.
Okay.
Yeah, and one more thing. Do we need for each trust? Do we need to have a stamp and a seal?
That is a good question. So you definitely want to have seals. We also have like a training in the program about it. Um, and so I would definitely tell you yes. So just have the mindset that you need like everything needs to be individualized, right? But the seal is, it's a good thing to have. It's not required.
Um, is it better to have those self-inking stamp seal, or is it the hard embossed seal,
I actually have both.
or both? Oh,
Hmm Yeah, and
okay.
you can use that to replace your signature. You can just put the stamp.
Got it. Got it. Thank you.
You're
I'll use
welcome.
it. Have a nice weekend.
You too. Thank you.
Thank you.
Next we have Paul.
Hey, how you doing?
Hi, Paul.
You can hear me?
Yeah, perfect.
Okay. Yeah, I just want to say I appreciate you for I took the class dealing with the trust. I was everywhere like air. So, but you did cleared everything up for me. So I'm very appreciative about that, and just looking forward to watching the rest of the videos in the portal. And I appreciate you.
Thank you so much, Paul. I appreciate you too. So it is just such a pleasure to have you be a part of the community and just know that we are a resource to you. So if you need anything, just let us know, okay? All right,
Okay,
guys. I think
I
I
got you.
put the binder link. Did you guys get it? I think I put it inside of the chat. Yeah, it's inside of the chat. And I'll have Angelica put in Telegram and Facebook as well. So with that being said, we are going to wrap up the workshop. Thank you so much for staying on for the whole 5 days. I think we spent like 30 hours together. So just know that we do it every single month. So the next workshop is going to be July 7th to the 11th from 11 to 2 Eastern Standard Time. You do have lifetime access to the workshop, so you will be able to attend and you will get the notifications in order to get access to that workshop. Next week, we have a master class, and it is going to be on buying, fixing, and flipping mobile homes. And then the week after that, we have another master class on mindset. So stay tuned inside of, and stay connected inside of the Telegram and Facebook for those announcements. And then you are going to also receive communication via text and email. So stay connected. And those of you guys that want me to double check your trust documents, please go ahead and book a call. My calendar link is inside of your email. Okay. So where you receive the workshop, you're going to see my calendar link in there. So book a call so that I'm able to double check your documents before you get them notarized. So with that being said, you guys have a highly, highly, highly favored and fruitful Friday and the rest of your weekend. And I will see you guys next week here on Zoom for the masterclass. Okay, don't miss it. Bye, everybody.
Bye. Thank you.
Bye. Thank
Peace and love,
you.
family.
Bless you
All right.
guys.